Good morning, everybody. Welcome back to another episode of the Market Open. It is Monday, November 17th. We are live, and we just went red. We were green in the futures. We were green last night, and we kind of just went red literally 30 minutes ago. I think there's a couple of reasons for why we're red that we'll talk about. And just across the board, I mean, the only thing that's really green is Google, and that is because Berkshire bought Google over the weekend, for those that don't know. But we are indeed red, and I think there's a couple of headlines that we'll talk about for why that's happening. Google right there up 3.2%. Google was pushing 300 last night. It was at 296. Unfortunately, it's going to be hard for Google to make those new all-time highs unless the broader markets are cooperating. And that's why you got Google going red, or Google at least going down from where it was yesterday. Nvidia officially going red, 186.99. You're getting some pre-Nvidia earnings jitters, I would imagine. And so that's why you're seeing Nvidia kind of take a little bit of a nosedive right there, down about 2%. It was up 2% yesterday after hours. So again, a complete 180 from what we saw last night. Apple right here down about 1.2%. Oracle down 1%. Rocket Lab down 0.5%. Bitcoin back to 93. Look at that candle right there. It was at 95 like 25 minutes ago. Now it's at 93.8. This is after Michael Saylor just disclosed that he bought another 8,000 Bitcoin for about $1 billion, $823 million over the past week. Still not enough to hold up Bitcoin. Bitcoin getting a bit of pain right there at 93.80. Then obviously Ethereum is probably going to be getting hit as well. Ethereum, 3,100. With that green candle. Ethereum got to 3,003 over the weekend. Bitcoin got to 92,000. So definitely going to be key levels to watch as we look towards the week to what happens with these stocks. And then Tesla right here falling below 400, down about 1.4%. The choppiness, once again, of the equity markets continue. I know it's only an hour into pre-markets, and we've got about 30 to 40 minutes left until the market opens, and this is the first day of the week, but nonetheless, you are still seeing some of that choppiness, even from the futures last night. Futures were bright green. I mean, we were up 0.5% on the NASDAQ. I mean, it was a pretty nice kind of momentum swing. And honestly, it didn't make sense why we had that momentum swing last night. I didn't think there was any major headlines, but then again, none of these moves have made sense in the context of headlines. They've all just kind of happened throughout the past 3 weeks. And it's something that we all are going to have to navigate. So we got a lot to talk about, lots to get into. Japan, I think, is also a big story that is important to discuss today for those that haven't heard about it. Japan is basically unleashing about 17 trillion yen or $110 billion of stimulus into the economy. There's good things about this. There's bad things about this. They have implications on the Japanese yen carry trade. They also have implications on Bitcoin and crypto. So we'll talk about kind of this Japanese stimulus and why the country is doing it in the first place. You've got macro updates in the context of data. So we got a bunch of Canadian data this morning, which is important. But now that the U.S. government is open, we should be getting more data this week. I do not believe we're going to be getting the jobs report this week. That should be coming next week. And so the anticipation of that jobs report is also going to be really important for the markets to kind of figure out exactly where they think the probabilities of rate cuts are going to go. Rate cut probabilities, once again, are below even where they were last night. Last night, they were at 45%. Right now, they're at 42.9. So until we get data that shows the labor market is struggling, which unfortunately is the data that the Fed's going to need, because for some reason, the Fed doesn't understand that the labor market is struggling. But they're going to need to see that data for us to get like a meaningful chance in terms of getting that rate cut. So we got a lot to talk about there. And then we got Nvidia this week. We'll do a preview on Nvidia because that's also going to be really important. I mean, at the end of the day, Nvidia's got to crush it. I think Nvidia will crush it. You got a bunch of street upgrades across the board on Nvidia. There's really not a fear, I think, that a lot of people have of Nvidia crushing it. It's just a question of if that's enough to get the market to stabilize and take that next leg higher. And maybe it is, maybe it's not. But this Wednesday, we're going to have those results and have a much better understanding of what's going to happen to Nvidia. Yes, Michael Saylor did buy Bitcoin this morning. 8,178 Bitcoin for $835 million, 102,000 a coin, which look at 102,000, he probably thought that was relatively low. And now unfortunately we're at 92,000, but he continues to buy. So they now have 649,870 Bitcoin at $74,000 an average per coin. And they've acquired them for about $48.37 billion on their average for Bitcoin. That is what we've got today. Yen carry trade gives me PTSD. Yeah, we got to talk about it. I mean, there are some there are some correlations between what Japan is doing to potentially increase what we've had before, at least, or what we did have before back in August. Japan key government panel member, government must compile stimulus package size around 23 trillion yen for spending tax cuts. See, I reported 17 trillion. Apparently, it's going to be much larger. The headline yesterday did say 17 trillion was the bare minimum. So, I mean, if it is going to be more than 17 trillion, Japan is obviously deciding that it's time to stimulate their economy. And quite frankly, a lot of this has to do with the population crisis and the fact there's a lot of older people in their economy, and ultimately they're going to have to pump money into the system to get the economy working again. So we'll talk about Japan, and we'll see what it looks like going into what happens in the United States markets this week. All right. Having said that, I think let's get started. So let's start off with some of the headlines this morning for why I think we're going red. These are just all my assumptions. I could be wrong about this, but let's get off with it. I mean, here's the first one. I saw this like 30 minutes ago, and I think this is why this might not be the only reason, but I think this is part of the reason. Amazon. Amazon kicks off a 6-part US dollar high-grade bond sale. You know, seeing this type of stuff, it's annoying, but you also can't blame these companies for doing it. But nonetheless, it is what it is. I mean, when you see companies start selling bonds and tapping the credit markets, we saw Oracle do this. Oracle got handsomely cut from 350 to 220 for this. Google did this, Meta did this, and now Amazon's doing this. The reason I think this is triggering a lot of people is because one of the ways that the dot-com bubble collapsed was that there was so much, not only vendor and circular financing, which we're already seeing examples of happening right now, but a lot of it was done through the credit markets, not through the free cash flows of the business. And as a result, that, ended up being painful. Now, the sort of nuance here is that it's freaking Amazon. Amazon can afford to raise debt, and Amazon can meaningfully execute on that debt in a way that, a lot of other companies can't. Amazon, right there, at 0.25% of the pre-markets. It's still green, but potentially will go red here. It was down 1% on Friday. And so, Amazon, Google, Meta should not have any problem selling debt. I mean, a lot of their debt is going to be due in 50 years, and their debt is yielding higher than a 10-year treasury, so they have plenty of demand for their debt. It's just the broader perception and narrative that this debt is not going to meaningfully lead to an ROI. But if you believe the debt-based data center build-out is not going to lead to an ROI, well, then you would have thought that using their free cash flows to build data centers was not going to lead to an ROI. So I think if you were skeptical about the data center CapEx build-out in the first place, then, whether it's debt or not, you're still skeptical. It's just the debt adds another level of concern when there shouldn't be, because Amazon, Google, these are companies that are not going to default on their debt, but it does add that concern to the market. And I think as a result of that concern, that's why you have some pain right there. So Amazon, that is down. And, interesting stat on Meta. Meta did more CapEx this year than net income on a trailing 12-month basis. It's kind of crazy, right? So you do have a lot of investors also a bit scared that there's way too much being spent on CapEx versus the actual, business profitability. And that's why Meta has obviously been getting hit as well over the past couple of weeks. Another piece of news on Amazon right here, and this news I think is kind of bullish. Jeff Bezos launched an AI startup. He raised $6.2 billion, and it is called Project Prometheus. The company is focusing on artificial intelligence for the engineering and manufacturing of computers, automobiles, and spacecraft. I mean, I thought this was kind of bullish because, at the end of the day, Bezos is coming back. He's going to be the co-chief executive, so he's getting back to an operating role. So he will be the CEO of this company. And at its core, it looks like they're going to be trying to find talent. They've already got 100 different researchers from OpenAI and Meta to come join the company. And it looks like they're going to be building AI that is uniquely geared towards very high-level tasks around spacecraft, automobiles. Obviously, Bezos has Blue Origin, so he's probably looking for how AI can make that company even better and more efficient. But it is cool to see Bezos come back. And, a lot of this is his own money that he's raised to be able to start this new company. Question simply becomes, how much does the market like, the idea of new startups into the ether when it comes to the AI race? And I think that's going to be a broader question that the market's going to have to answer. Nvidia right there down about 1.4%. Tesla down 1.3%. Nebula is still holding on a little bit. That's up 1.3%. Oracle just went red. Iren just went red. Cypher went red. All your Bitcoin miners went red. SMCI is red. CoreWeave is also down about 0.7%. Real quick stat for you guys as well that includes CoreWeave. So Bloomberg did an analysis of the top 3 largest hedge fund increases, and we'll go over 13Fs in a second. as of 3Q. Nvidia was number 1, Alphabet was number 2, Apple was number 3. Nvidia, Alphabet, and Apple. The 3 biggest decreases were Intuit, Salesforce, and CoreWeave. So CoreWeave was up there, and their debt to equity ratio is now surpassing 300%. You got a lot of people that are just afraid of what CoreWeave's doing with their debt. But CoreWeave, Intuit, and Salesforce were the top 3 sold names. Nvidia, Amazon, Nvidia, Alphabet, and Google were the top 3 added names. Berkshire being the most high profile that we'll talk about in a second. BMNR, I think we just got a update on how much Ethereum they have. Do we have this right here? Let's see. Yes, 3.6 million Ethereum. 3.6 million Ethereum just came out right now. 2.9% of the entire ETH supply. As of November 16, 7:30, the company's crypto holdings are comprised of 3.559 ETH at 31.20. They have a $37 million stake in Orbs, and they have $607 million of cash, along with $192 million of Bitcoin. Tom Lee, crypto prices have not recovered since the liquidation event on October 10th, and the lingering weakness of the hallmarks of a market maker or two suffering from a crippled balance sheet. When a market maker has a hole in their balance sheet, they're going to seek to raise capital and are reducing their liquidity functions in the market. This is the equivalent of QT for crypto and is the effect of dampening prices. In 2022, this QT effect lasted for 6 to 8 weeks, and this is probably happening today. We do not believe crypto prices have peaked for the cycle, and this is covered in our November chairman's message. We look at 5 explanations for the crypto price cycle and conclude that the 2 have important explanatory value. Both of these suggest the crypto cycle top is likely 12 to 36 months away. Yes, this is a break from past cycle behavior. Okay, so I believe they had, 3.2 million last week? So does anyone remember exactly how much they had last week? Let me check real quick. I think that's a pretty significant increase, if I'm not wrong. They had last week, they announced the CEOs last week. No, they had 3.5. Okay, so they added 100,000. 100,000. Okay. So about 100,000 more ETH they added to the pile. I mean, it's a decent sized buy. It's not a huge buy, but it is a decent sized buy. And unfortunately, Ethereum is just, Bitmine's not going to go higher if Ethereum continues to be stuck where it's stuck. Ethereum right there, 31.18. That's down about 2%. Bitmine about 34 in the pre-markets. So yeah, it's actually just 54,000. You're right. I'm rounding up to 3.6, but it's went from 3.5 to like 3.559. So it's about 54,000. HIMS also did announce a share buyback. That is correct. They announced a $250 million share buyback. I think it makes sense. I mean, at the end of the day, HIMS is growing fast. They don't really need to buy back their shares, but they are shorted heavily. So when a company is shorted this much and they're growing at the, their HIMS is trading at less than 4 times sales. So it is kind of crazy how their momentum has died off. You would imagine that if the shorts are in control, then a buyback would at least help to potentially get the shorts to be a little bit more scared. So I don't think it's crazy that they're buying back a bit of their stock as long as they can continue to keep up the growth that they're doing as well. So that's what you got on Bitmine, and that's what you have on HIMS as well. All right, 13F. So what happened over the weekend? Well, we saw this on Friday. This actually happened in Q3, but it was disclosed on Friday. It was, I think, the biggest news of the weekend, quite frankly. Berkshire bought 17.8 million shares of Google. This was a very, very, very big deal. It's hard to explain how big of a deal this is. Berkshire, when they take a position in a name, they take a position and they let everybody know they take a position. You have millions of people, honestly, probably tens of millions of people across the world that follow what Berkshire does. Buffett probably didn't make the decision because he's retiring. It was probably other leadership at the firm like Greg Gable. But the fact that you have Berkshire leadership coming together and saying, we believe that we need a technology play in the portfolio after really not having any technology over the past decade outside of Apple, which they didn't even consider was technology, is quite incredible. And to me, it's kind of validating some of the AI trade. And the reason it's validating the AI trade is because Google's going to spend a ton of money on CapEx next year. Google's obviously growing because of Gemini and Waymo and all their bets around AI, Google search being enhanced through AI mode, et cetera. Like there's cloud that's really growing because of the AI workloads that Google is contracting for. So, a betting on Google is a bet on AI. Now, if AI went away, would Google go away tomorrow? No. But is there a world in which Sundar would even let the opportunity present itself that another company could take its lunch if they focused on AI more and Google kind of took their foot off the pedal? I don't think so. I mean, and you had that existential crisis for Google back in 2023 when ChatGPT was growing as fast as it was. And a lot of people started thinking, hey, maybe I'm never going to use Google again. Obviously, that narrative has flipped and Google is now in a prime position to win. But I think a $5 billion stake, although it's only 2% of the portfolio, is admitting that we need exposure to something in the world of AI. It's admitting that this CapEx spend is not going anywhere. And it's also admitting that, quite frankly, Google is probably one of the best and most diversified AI companies because eventually Google will stop spending on CapEx and all that money will go back to share buybacks and free cash flows. And Google's business is likely going to be resilient in the face of AI, if not enhanced in the face of AI, as being the world's largest toll booth for search-based advertising. So I think it's really nice to see Berkshire invest in an AI company. I think we're probably going to get more of these investments from other different funds. You're going to have a lot of people, in my opinion, that follow Berkshire religiously that are just going to buy Google. I mean, the reason Apple became one of the most amazing stocks over the past 10 years is once Buffett touched Apple and everyone was like, oh, Buffett's given, the Buffett cosign. A lot of people started buying Apple and, they didn't sell Apple. So in order to do this, by the way, Berkshire did sell about 16% of their Apple stake, which makes sense. They've held on to it since $500 billion market cap, but it does make sense they're transitioning into a company that can grow a lot faster. And I think this might be the start of a new, potentially technological driven Berkshire Hathaway over the next decade, potentially. It's going to be something that's exciting to see if they do that. But you have them taking a stake in Google. S&P 500 right there, still down in the pre-market, 670. That's down 0.22% in the pre-markets. Ford, Amazon strike deal to sell used cars online. Okay, so you have this deal that was in the rumors for a long time. It looks like it's officially happening. Ford stock flat in the pre-markets. Amazon also up a little bit. You can now buy used cars on Amazon. This is why Amazon is a must-hold, I think, for the next decade, dude. Amazon it's not going away. And if anything, their margins are going to get better and better with AI, which is, more net income. And they're still trading at the lowest EV to EBITDA multiple across all the Max 7. So I still feel like Amazon right here is definitely going to be a hold for a long time. That's what you got on Google. Some of the other stuff in the 13Fs that were disclosed, Stanley Druckenmiller also bought Google. David Tepper sold all of his UNH. Peter Thiel, I know this has been making the headlines as well, has sold all of his Nvidia and basically 76% of his Tesla. He did take new stakes in Apple and Microsoft, which was weird. Because, if you're getting rid of the entire AI thesis from your portfolio and getting rid of Nvidia, why would you kind of buy two names that are also in AI? But I guess he wanted a bit more safety and they're probably not as volatile as Nvidia. But yes, Peter Thiel did take his entire Nvidia stake off the table. I don't think that's that crazy. I mean, I know a lot of people are trying to put the narrative together that if Peter Thiel is selling and that SoftBank is selling, then, everyone's getting out of Nvidia. I think that is one narrative and that's one argument. I also think a lot of these guys have been in these names for a long time and SoftBank's been in it for like 10 years. So eventually they're going to take some profits. And it's not crazy that they're going to take some profits. Yes, Thiel also sold 50% of his BMR. Now you got to remember, Thiel got to BMR at $4.50. He was one of the original backers of the IPO of it, or the re-IPO, because it was already a public company, but they kind of rebranded themselves. And so, I mean, it makes sense, right? If you got in at 450, you saw that thing go to 40, he's up 10x. Thiel is not going to be the one to not take profits on something like that. So makes sense that he took profits there. Then you had Thiel also selling his Nvidia stake. I think the broader question here becomes, do we think the selling of some of these names by super investors, because, as Thiel sold Nvidia was still one of the top ads in Q3. You had a lot of other people that bought Nvidia. So then the question just becomes, do we think that there is a decent amount of sell pressure versus buy pressure in the context of their earnings? And if you read any of the equity reports for what people are thinking going into earnings, it seems like Nvidia is going to crush it. And my fear is not with Nvidia earnings or that Peter Thiel is selling or SoftBank is selling. My fear is much more a question of the labor market, which we'll talk about in a second. But my fear is more rooted in macro right now, not really company specific earnings. Evercore said you should buy Nvidia. They expect Nvidia to deliver a beat and raise quarter, citing channel checks show that GB200 and GB300 availability is greatly improved, yet demand still outstrips supply. And that is the reason why Micron's higher. That is the reason why Broadcom is higher. I mean, this idea of demand outstripping supply in the context of AI CapEx continues to be very real. In fact, talking about demand versus supply. Elon and Sundar this weekend had a conversation on Twitter. Elon says it's mind-blowing how much money is being spent on AI compute so fast, but still many orders of magnitude to go. This is because Sundar tweeted that they're investing $40 billion in Texas for data centers. And then Sundar says, between abundant sand, plenty of sun, and space, literally, to put it in, we can do it. So you've got Elon wanting to build his own chip farm and Sundar wanting to put data centers in space. I mean, when we hear this whole conversation around bubble, which I've been hearing a lot more of over the weekend, that's fine. That is a perspective that people can have, and it's healthy to have that perspective. But then you see two of the CEOs of leading AI companies saying that we can't build these things fast enough. And we're trying to figure out the capacity on this planet, and we might have to go outside of this planet just to be able to build all these data centers because they think it is going to be that big of a deal. And maybe it will, maybe it won't, but that is the argument from some of the most important tech CEOs on the planet in terms of what they're thinking about when it comes to data centers. So that's what we got with Nvidia, down about 1.5% right here in the pre-markets. Crypto still getting hit. Yes, crypto is down 93.74. We talked about it last night in terms of what's going on, and you're probably going to keep hearing this argument about forced deleveraging and structural deleveraging. I think it is a legitimate reason for why crypto is getting hit. For all these perpetual futures contracts that have been introduced, and we'll talk about Japan in a second because that also has an implication right here. A lot of these perpetual futures contracts, unfortunately, have allowed people to go, from as little as 10x to as high as 250x on leverage. And when you're on 250x of leverage, or even 100x of leverage, as you can see, there's also been weekly crypto asset outflows in the Bitcoin ETF funds. Even a 2% move will liquidate your entire position. So from that perspective, and we saw this on October 10th, there was a $19.2 billion liquidation in crypto because Bitcoin had a $20,000 candlestick. And I mean, obviously that took away a lot of money from the system. As a result, Tom Lee's argument is there's plenty of macro or market makers that also suffered during that liquidation, and they're now having to sell to recoup a lot of the losses that they have. Does that put crypto in a structural bear market? I don't know. I would say no. I would say just like any stock that has a liquidation from a margin call or something like that, if someone's heavily levered into that stock, like it's going to create some short-term pain, but eventually the fundamentals come back in place. With crypto, you've got to believe in a different sort of paradigm of fundamentals versus like a stock market fundamental thesis. But if this is a structural deleveraging and not the beginning of a bear market, then crypto should be okay. The problem is no one knows. And you got a lot of people that are starting to think that crypto winter is here, right? And that is pretty ugly. I mean, if you look at Bitcoin from November 17th last year to November 17th this year, Bitcoin's down, which is kind of crazy. If you just held it for a year, I mean, a 10-year would have got you a better return than Bitcoin right now. So it's quite incredible to see this. And the other reason why crypto is taking a hit is because, unfortunately, the Fed has not really given any level of meaningful clarity on a rate cut. Again, the probabilities for a rate cut are now below 50%. Bitcoin thrives on liquidity. And funnily enough, we've added more to the M2 money supply over the past 6 months than we have over the past couple of years. And like M2 money supply going higher, if you put that on a chart with Bitcoin's price action, Bitcoin's going lower. So it's almost like more liquidity into the system is not really helping risk on assets right now. And in order for it to thrive, it's going to need even more liquidity. But if we're not getting a rate cut in December, I mean, the lack of liquidity is going to continue putting some pressure on Bitcoin. So unfortunately, it's going to be one of those assets that's going to need a real narrative rebooting over the coming days. I don't think we get Bitcoin 200,000 by end of year. I really think it's going to be hard to get Ethereum 7,000. I would just be happy if Ethereum gets back to 4,000 and Bitcoin like stays above 100,000 at this point. And maybe that, lack of sentiment is enough to kind of pump these things, but they're going to need to really work to get back to their price action. And unfortunately, that is what we're seeing right now with Bitcoin. Quick thing on Apple, and then we'll get into what's been going on in Japan, which also has implications on Nvidia and Bitcoin. Apple iPhone 17 demand seems strong. JP Morgan reports that global iPhone 17 lead times remain unusually long, averaging 7 days in week 10 versus 2 days last year. The bank says this shows supply is still strong behind demand. The base iPhone 17 has the longest waits for the second week in a row. The iPhone Air saw a 1-day increase in wait times, while the iPhone 17 Pro and Pro Max stayed steady, unlike last year's Pro models, which saw shorter wait times at this point. Tim Cook is also likely stepping down as per next year, early next year. And the current VP of engineering is going to be taking his spot. But that is another thing about Apple. And that's also another reason why maybe Berkshire is trimming a little bit. Now that Tim Cook is stepping down, you're going to have a bit of a management change. And so you have some people that probably, want to see how the new CEO does before they buy back in. Apple right there, 269 in the pre-markets, down about 1%. Tim Cook did guide for 12% Q4 revenue growth, fastest growth they've seen in about a year. So if they are able to execute on that 12% growth, that'd be very strong going into Q4 for Apple. Amit, would you sell covered calls on Grab for next year at $10? I think it's a little tricky picking 10 because although 10 seems far away and the covered call is probably going to need some good premium right here, question is the premium enough? Grab right there down about 1% of the pre-markets to be stuck in it if it does make a move higher. I don't hate that, especially if you're fine selling at a double, right? If Grab actually doubles from 5 to 10, then that's an amazing price to sell at. But if, Grab ends up getting a lot of inflows based on the U.S. markets not doing the best, there's a thesis for why that one could actually be a sort of safe haven next year. Ray Dalio added to Grab 4.5 million shares. Howard Marks added to Grab. You have a lot of other these bigger funds adding their institutional holdings is nearing 87%. So you are seeing more inflows, even though the stock has not been cooperating. But yeah, look, if you're fine selling for $10, then I think that is a reasonable price to sell your covered call at. Yeah, we saw the Amazon deal. Amazon and Ford have signed a deal to sell certified used Ford cars through Amazon's e-commerce website. More and more opportunities for Amazon to continue selling different products online. All right, so Japan. Let's talk about Japan and what's going on with Japan. So we've got a lot of stimulus in Japan that has been introduced over the weekend. And the stimulus is really important to kind of analyze why it's happening. Now, one of the reasons this caught my attention is because if you take a look at the Japanese 10-year yield, it's at its highest level ever. Now, why is it at its highest level ever? Well, the bond market is selling off a crap ton of bonds because the cost of capital in Japan is slowly becoming lower and lower. And so they're demanding a higher yield to be able to say we're going to, buy Japanese debt. Now, why is the cost of capital getting lower? Well, because Japan is stimulating like crazy. And the reason they're stimulating, I think, has to do with a variety of issues. So here's a couple of kind of core headlines of how this is playing out. Number one is the stimulus itself is focused on tax cuts, energy subsidies, and the cost of living relief. This all sounds great, but the problem is that you're cutting taxes and spending more money than your central bank is trying to normalize policy by raising rates. There's a contradiction right there. The BOJ has been raising rates. They want to tighten monetary policy by raising rates. Remember, the reason the yen carry trade happened last year is because the Bank of Japan rose rates by 25 bips. But the government is loosening fiscal policy at the same time, which forces the BOJ to keep rates artificially low to avoid crushing the economy. The BOJ's policy rate is 0.5%, and that sounds positive, but inflation in Japan is around 3%. So the real interest rate, which is nominal minus inflation, is actually negative 2.5. That means if you deposit money in a Japanese bank earning 0.5% while prices are going up by 3%, you're down 2.5% in purchasing power. So what are people going to do? They're going to take their money out of yen-based assets, which is why the yen is getting hit this morning, and they're going to buy other stuff instead. Quite frankly, they might buy Bitcoin because that might give you a better yield versus the rate of inflation, or they just might buy US equities. So the stimulus is actually guaranteeing that the yen gets weaker. A weaker yen means import costs go up, food, energy, materials, everything gets more expensive. The whole point of the stimulus was to help households with the cost of living, but the fiscal expansion is simultaneously destroying the purchasing power of the yen. Now, if the BOJ were to lower rates, this would make a lot more sense, but they are not doing that. So that's where you kind of get that contradiction. And it's giving people tax cuts with one hand and taking away their purchasing power with the other hand. And that is also why bond yields are rising. The market sees this, and obviously they know that it's unsustainable. Now, that's the bear case to this. The bull case to what's kind of happening right here in the context of the US dollar is that the yen carry trade is a strategy that essentially involves borrowing yen and then investing in something that's paying higher. Even, US treasuries, which are paying at a premium to the 10-year bonds in Japan, which is 1.7%. US is like 4.1%. So you're getting a delta of 3%. So one could argue that as the yen weakens over the dollar because of all this stimulus, even though the stimulus is kind of contradicting itself because you're raising rates at the same time that you're printing money, which makes the nominal inflation continue to be negative, which again doesn't make it easy for banks to necessarily lend as much as they were doing in the past. People would still be borrowing in yen and buying US assets. So it's one of those things that I actually think could be relatively bullish for Bitcoin and tech stocks, because as the yen continues to get lower, there could be an argument that people just say, hey, I can continue borrowing yen and doing what I need to do. The 10-year right there at 4.13%, slightly down, but still above 4%. But obviously the dynamics of what's happening internally in Japan is weird, because if you're going to be raising rates or keeping rates high and then printing all this money, it's not really the best form of stimulus. And the actual number one reason they're doing this is, once again, this idea of affordability. I mean, we thought it was an American sort of argument that has been coming up, but the reason that the new Japanese prime minister, the first woman prime minister that got elected a couple weeks ago, the reason she's initiating this is because a lot of the Japanese people have been saying that life is becoming unaffordable in Japan. And as a result, all this stimulus is trying to find a way to get costs to come down. Now, here's the real kicker here. If you can actually have a debt to GDP ratio of 230%, which is what Japan has, if you can have interest rate hikes at the same time that you're printing money, which usually doesn't happen that way, and if you can have if you can be the largest owner of foreign treasuries, which Japan is, they own about 1.1 trillion of US treasuries, and you can get away with printing $110 billion, probably more than $110 billion, over 23 trillion yen, and have it be effective, I think the precedent that sets for a lot of other countries is, oh, maybe we can do the same thing that Japan's doing, which I don't know if that's the best precedent or a horrible precedent. But Japan is doing another experiment right here. Again, they are one of the most indebted countries as in a percentage towards their GDP on the planet at 230%. By the way, their 3Q GDP was negative 1.8%. This was the first negative quarter they had in 6 quarters. That's probably another reason that they're printing money, is because growth is obviously now contracting. If they get away with this and it somehow is effective, which we'll see over the next coming years how effective it is, it's going to give a lot of ammo to the United States to say, hey, we can probably print more money as well and get away with it, which is the macro argument to continue buying Bitcoin. I'm not suggesting that is like the end all be all, but one that you could understand why people want to buy some type of asset that potentially is the answer to the debasement of global currencies at scale. Now, granted, that asset intrinsically is tied to all the stimulus of the currencies and the debasing of the currency, either up or down. So and we're seeing Bitcoin not really cooperating with some of the more positive arguments. So you have to kind of grapple with that argument in and of itself. But at its core, if all these countries are going to be debasing their currency at the level they're debasing it at, and just saying we don't care because the cost of living is too high and we need to get prices to come down in the short term, in the short, next 2 years, maybe that has an impact. In the next 100 years, who knows what impact it has. But you do have the bull and the bear case for why people would want to buy Bitcoin in that scenario. Bessent, yesterday, speaking of affordability, he is trying to justify why prices are so high. Here's what he had to say about the cost of beef in this country.
But what is your take on what you just heard? He's expecting $10 meat.
Well, Maria, the beef market is a very specialized market. It goes in long cycles, and this is the perfect storm. Again, something we inherited, and there's also, because of the mass immigration, a disease that we've been rid of in North America, made its way up through South America. As these migrants, they brought some of their cattle with them. So part of the problem is we've had to shut the border to Mexican beef because of this disease called the screwworm. So we're not going to let that get into our supply chain. And again, I don't want to focus on one product. It's a very important product, and we are laser focused on this issue. And
so Bessent's argument for that is illegal cows has been leading to a lot of the increase in beef. When he was asked about the tariffs in Supreme Court, which will be making a decision in a couple of weeks, here is also what he said about the Supreme Court decision coming up.
say this in the strongest possible terms. I think that there are 3 points here. Is one, this is one of President Trump's signature policies, and traditionally this Supreme Court does not interfere with a president's signature policy. 2, this is an emergency authority, which is IEPA. President Trump has successfully used that. To, as we talked about earlier, on the rare earths problem, he threatened substantial tariffs on China, and that made the rare earths flow.
Yes.
2, numerous of the peace deals that he's negotiated, he threatened to put tariffs on the countries, and that got us to the peace deal. 3, when we're talking about fentanyl, we had fentanyl tariffs. And what is more of an emergency than hundreds of thousands of Americans dying every year? No one had been able to get the Chinese to the table with these precursor drugs.
Right.
And then 3, I would push this back onto the Supreme Court. I don't think this ruling is going to go against us, but if it does, what's their plan for refunds? Because how is this going to get to consumers? Are they just going to hand the some of these importers big windfalls? What if the exporters have given big discounts already, and then you're going to give a refund on the tariff? So they'd be making it on both sides. So I don't think the Supreme Court wants to wade into a mess like that.
Yep.
So we're going to see how this ends up playing out. Obviously, Bessent, you can see a little bit annoyed right there about the Supreme Court decision, and his argument is that the Supreme Court is not going to rule against the administration. We're going to find out in the coming days what actually happens. I'll put the red or green poll right here in the chat to see what people are thinking, green or red today. And then on beef, he's making a different argument for why beef has, increased in prices. The administration did say over the weekend that they would be decreasing tariffs on beef, coffee, and bananas with an attempt to kind of lower some of those prices. Again, coffee is up a lot because we tariffed Brazil by 50%, which increased the price of coffee. So those tariffs should be coming down. And hopefully that helps on this affordability narrative. The broader question, I think, for the administration is how they're going to communicate that to the broader public. And, as of now, they're trying a variety of different things. Here's Kevin Hasset this morning, again, on this idea of affordability.
I don't know, is it Trump's fault?
Right. Well, I mean, for sure, people still are trying to dig out from the big hole that was dug by the previous administration's policies. So if you figure the typical mortgage payment, monthly mortgage payment about doubled. If you look at a typical bag of groceries, the monthly bag of groceries cost about $400 when President Trump was leaving office last time, and about $512 right about when President Trump took office. And since then, it's gone up almost not at all. I think it's like $515, but it hasn't gone back to $400. And so what the Democrats are doing is they're saying that this runaway spending that we gave you guys that created runaway inflation is 100% your fault. Because you haven't fixed it already. And of course, that's very economically illiterate. And I don't think really many people in markets are buying it.
Well, I'll tell you, Kevin, one of the reasons I think that people are, and I'm going to highlight both sides, one of the reasons people feel like they're not keeping up is because real average weekly wages fell during the Biden years because of the inflation.
$3,000, that's right.
Right. So it fell. However, the president is constantly saying prices have come down. Now, inflation is still 3%. It's still too high. Now, oil prices, energy prices, there are certain things where they have come down. But when you keep saying prices are falling, that's not true because inflation is still, the 3% is on top of all the inflation we had during the Biden years. So we got all that inflation plus an additional 3%. And we should, I think you should admit that.
A more precise way to say it, though, Joe, is that purchasing power has gone up. And so real wages, that's W divided by P for our technical people in the audience, have gone up by about $1,200 this year. So the way to think about it is that we've dug a $3,000 hole because of Biden policies, and we've gained $1,200 on the way out already, which should give you a great deal of hope for the future that the wage increases that we're seeing will continue. And even if inflation stays positive, make it so that people feel way better when they go to the grocery store and to buy a car. We've reduced the cost of buying a car with the deductibility of interest. I mean, there's a million things that we're doing to fix this problem, but it's just kind of astonishing to me that the cost problem is somehow being blamed on us. Now, think about it, especially with the Obamacare thing. So Obamacare is 100% Democratic policy. It's always been 100% Democratic policy. What they did is they expanded the subsidies during COVID, and then all those subsidies basically went right into the pockets of insurance companies. And Obamacare insurance policies have doubled in price relative to normal policies. And so the fastest inflation in the economy is these big government subsidies thrown at Obamacare insurance. Think about it. It's kind of like if you give lots of student loans, then the tuition goes up. It's that effect. And so now they're blaming President Trump for Obamacare as well. They should have fixed Obamacare in the first place. And President Trump had a plan in the big, beautiful bill to give people some subsidies, but the Democrats didn't like it because the subsidies weren't going to their campaign contributors, the insurance companies.
It is going to be a large discussion, I think, in 2026. If I did not see this narrative. Like, I think when we were analyzing the Mamdani election, a lot of it was rooted in the context of the bifurcation of the economy and the wealth effect, right? The divide between the rich and the poor, and how that led to a leader like Mamdani getting elected in the mecca of capitalism, which is New York. What it created was S&P losing 670 in the pre-markets. What it created was a broader argument around the concept of affordability, and it became a national discussion. And the administration almost did a full 180 over the past 2 weeks and having to embrace this whole concept of, being more affordable or creating a more affordable country. And now it is the single biggest thing that Bessent or Hasset or JD Vance or Trump are talking about. So I think over the coming weeks and honestly months, we're going to get a lot more insight into how they're thinking of affordability. And then the American people are going to decide how affordable the country is. One of the only names that's green in the pre-markets, folks, is Google. Google's holding on because it got the Buffett cosign. We got about a minute until the market opens. Nvidia tanking 2%. Palantir, I think, is losing 170. It's very close to losing 170. Hoodie, very close to losing 120. Kind of weird. Last night, we were blistering green. We were very, very green. And that flipped in the pre-markets. When I woke up, it just looked like a totally different market. And now it looks like it's getting worse. In about 30 seconds, we're going to see if this flips. If the bottom falls out, we continue to go lower. We have a little bit of a sort of Friday morning reaction, or if this V-shapes into green. I'm not sure what exactly is the headline. Amazon did raise about $12 billion of bond sales today. So maybe the street just getting upset that some of the hyperscalers are continuing to tap into the debt markets. But you are seeing a bit of a reversal right here as we see some of these names going red into the market open. All right, here we go. Monday, November 17th, 9:30 a.m. Thank you, everybody, for being here. The stock market is now open. All right, wake your ass up. Let's get into it. S&P goes down 0.5% at the open. 0.5% at the open, 669.18. We are red on the day. Bitmine down 2%, Grab down 0.5%, Apple down 2%, Palantir actually got a little bit of a bounce from the pre-market lows. It was at 170, now it's at 171. Robinhood continues to go lower, 119.55. Robinhood down about 2.4%. Google 287. Google's getting the Berkshire love. Google's not really tanking yet. You got everything going red except Google. That is all people piling in after Buffett has officially said this is going to be his next tech stock that he buys. S&P is still red. AMD goes down 2%. PayPal down 0.5%. Nvidia 2.6% down on Mr. Nvidia as Nvidia goes red on the day. Pretty incredible. But you got Nvidia going red, 185.40 on Nvidia. AMD right there, 242. That's down about 1.2%. Nebius actually green somehow. Nebius is holding on to his green. Rocket Lab continues to go red. And Bitcoin right there at 94,000. Micron's at 248. That goes green. IREN, that's down 1.64%. Cypher, that's down 3%. SMCI, that's down 2.8. CoreWeave, that's down 3.7. CoreWeave getting hit. Wow, why is Dell down 7%? The hell happened to Dell? Goodness gracious. All right, Dell's getting hit. So that one goes red. Dell right there down 7. HIMS is down after initiating a $250 million buyback today. Nvidia right there, 185.75. That's down 2.3. Dell got downgraded. Okay, I'll check the downgrade in a second. That's obviously hurting Dell right here. They have earnings November 25th, so in about 8 days. And we'll see what we get from Dell. That one continues to go red. SMCI is red. AMD's down 1%. Palantir actually not really getting hit that bad. It was at 170. Now it's at 170, 130. You got some green candles right there, even though it is a bit red. Grabs went green just now. Robinhood trying to recover a little bit, but still down on the day. Amazon goes red. Bitmine down 2.84% as Ethereum gets hit. Ethereum right there at 3,100. Google, wow, 290. Google's pushing through 290. There you go. The Goose is green. She's not going to go down just because the market's going down. Not when Buffett's taking a stake. S&P 670. Got S&P 670. That's not green yet, but it is bouncing from 668, which is nice to see. That hopefully will help Nvidia. Nvidia getting a little bit of a bounce right there as that one goes green. XPEV missed on their EPS. They beat on revenue, if I'm not wrong. That's why that stock is down 6%. Again, I don't know that much about the company, but they did miss on the bottom line, beat on the top line, and I think that's why the stock's getting hit. ASTS, that's down 1.3. Rocket Lab's down 1.4. Micron, 253. What a name Micron's been all year. I mean, just an incredible name. This thing was stuck at 60 for the majority of 2024 and then just broke out this year. So Micron continuing to do well. I think they got another upgrade to $300 this morning as well from Rosenblatt on more DRAM demand. So that could be another reason that's up. Corey right there, that's down 2.5. And then Lemonade down 2%. Is Hoodie still getting hit? Hoodie's still getting hit, 118. I mean, this actually makes sense to me because crypto tanked over the weekend. I was quite surprised that Robinhood was green last night in the overnight markets. But Bitcoin going from 100 to 94 and Ethereum from 33 to 31. I mean, it's good for Robinhood in the context of volatility. They're probably making money off some of this stuff, but obviously crypto going down doesn't really help them. Coinbase that's also losing 300. That's down 4%. ARM is up by 2%. You got ARM getting some green, and then MicroStrategy that bought another 8,000 Bitcoin this morning. They are below 200 at 198.74 for MicroStrategy. The world's highest IQ record holder, Young Hoon Kim, says Bitcoin will hit 220,000 in the next 45 days. So the guy with the highest IQ on the planet, as per Bloomberg, says Bitcoin will hit 220,000 in the next 45 days. I really hope we can trust his IQ over the next 45 days, but I don't know if it's really going to work out. Micron right there, that's up 3.79%. That's green. Cypher goes down. Bitfarm still down 2%. Nubank, that's up a little bit as well. As that goes green. Yes, he is Korean, correct. He is Korean. I mean, dude, if you got the highest IQ on the planet, like, yeah, help us out, dude. Like, tell us what's going to happen. If you're the smartest guy in the world, let us know what's going to take place. Maybe he'll be right about Bitcoin. Oklo below 196. SoFi down 1.3%. SoFi gets hit. Where does the S&P go if Bitcoin goes to 250,000? See, that's why I don't even like these price targets on Bitcoin, because if Bitcoin were to somehow get above 200,000, I mean, it's not going to go there by itself. Like, it's a macro asset that has to correlate with the NASDAQ. So, I mean, you're talking about S&P, I think, well above the 7,000 range. I mean, we're talking about close to 8,000 if you have any level of a doubling on Bitcoin. It just seems rather impossible to me. Maybe it does happen, but I mean, you know, in the early days, Bitcoin was uncorrelated with macro assets. As it became a global player that is impacted on global liquidity, I think it's really hard for Bitcoin to have that big of a bull run and for the equity markets to not correlate with it. I think people would just be happy if Bitcoin could, you know, even stabilize above 100,000 by end of the year. Ethereum right there, 3150. I mean, even Ethereum going from 3,000 to 4,000 now is going to be a challenge. It's not going to be easy. So all these crazy targets on Ethereum, I think people would just be happy if it gets back to where it was before. SMCI down 2.5%. CoreWeave down 2%. Red Cat down 1.4%. Nubank's down. Big Bear, this thing was $8 last week, $5.95. A lot of these high beta names have been getting hit. Quantum goes down. D-Wave down 2.3%. IONQ up just a little bit. Rigetti down 0.5% as well. Nebius, for some reason, is holding green. I mean, look, I think Nebius's market cap compared to their earnings growth and their projected revenue guidance is kind of silly. Nebius at 21 billion, but it is still a data center play. But you are seeing a little bit of divergence, right? I mean, you know, there's a reason CoreWeave's down and Nebius is up, and a lot of it has to do with their debt profile. Oracle right there, that's also slightly flat. Tesla, are we getting any green? Tesla up. We went green on Tesla. Went from below 400 to 406. It was at 397 right before the market opened. Now it's at 407. That goes green. S&P went green. Wow, S&P went green. Okay. S&P is greeny green. Tesla's green. Hoodie's trying to go green, still at 119. Palantir very close to going green. Grab just went green. Bitcoin just got a, dude, what a candle. Was it not at just 93? No, it was at 94. Bitcoin right here is Bitcoin at 96. I think Bitcoin's in, wow, not 96 yet, but close. Goodness. All right, I guess potentially Google 291. Now they might, like, if the S&P is running, they're going to let Google run. They're going to let Google go. EOSC just went green. Cypher just went green. Dude, how many times has this happened over the past 3 weeks? We dump at the open, we chop around a little bit, and then we go green. And then we dump again a little bit later, and then we go green, and then either we end red or green. It's a coin toss going into the end of the day. But it feels like that playbook could be playing out again today. Element's going green. You got the healthcare names going up. UNH is green. Oscar's green. CNC is green. Netflix has officially split. Netflix is split. $110 a share. Still a $470 billion market cap. But if you own a share of Netflix, you now have 10 shares. ASTS, that one just went green. Oracle, very close to going green. S&P 672.38. VIX is still high. You're right. The VIX is still over 20 right now. I mean, we'll see if that comes down if we get a little bit more of a move in the broader market. Not everything is going up, but you do have stuff that's trying to find a little bit more of a bottom right here. MicroStrategy also going green as well at 200.75. Yes, I got 10 shares of Netflix based on that one share I bought last week. That's why you couldn't even trade Netflix last night on the overnight markets, because they were going through the split. Buy one, get 10 free. I mean, to me, it's a hell of a deal that they put out there. Micron, wow, 260 on Mr. Micron. That's incredible, dude. That's incredible. Micron, what a name. Just one of the best semiconductor names all year. Literally one of the best names all year. Year to date, this thing is up 200%, 197% for Micron. Google, are we at all-time highs? Google, 292.43 is the 52-week high. 292.43, so very close to breaking through those all-time highs. Man, I think you found the infinite money glitch. Yeah, dude. I think I found the infinite glitch. Rigetti right there, 25.64. Nebius going green as well, up 3%. MicroStrategy, that's up 1%. ARM's up a little bit. And then Micron, that's up 4%. S&P trying to actually make a move higher, 672.50. Palantir 172. Grab going green at 550. Bitmine also potentially going green at 34. HIMS is green a little bit. And then Ethereum almost at 3,200. Is Hood above 120? Do we make a move above 120? Not yet. 119.38. Very close. Very, very close to getting there. AMD goes green as well. 247. As we continue to hold on to a bit of momentum. All right, so here's the question then. Here's the question for a lot of people. I'm curious what people are thinking, because there were a variety of podcasts I heard this weekend that were just unbelievably bearish about the state of AI. And it is. By the way, 53% of you said we would go red today. Here's the question. Do we have a Santa rally? Yes or no? I define Santa rally as S&P 7,000, or at least very close to 7,000. I mean, that would be a legit rally from these levels, which again, S&P still up 15% year to date. It's not like it's in some horrendous territory. It's just some of these other names have been hit pretty bad, which is why people are feeling it. But you're not necessarily in a bear market this year. I think there's two scenarios. I think you get a Santa Claus rally if the labor market data is bad enough to justify a rate cut, but good enough to not say that corporate earnings are going to be meaningfully hit next year, and the Fed actually ends up cutting. I think the way we don't get that Santa rally is if the Fed looks at that data and says, we don't care, we don't think we can cut, which again, it is unfathomable that the Fed thinks that inflation is a bigger concern than the labor market right now, or they think that the labor market declines won't necessarily lead to deflation because if people don't have jobs, they're not going to be spending money, and boom, there's your argument, your natural hedge around inflation going down. Like, I really can't believe that they care that much more about inflation at this state of the cycle, but that's what the Fed presidents have been saying. And you got a bunch more Fed presidents talking today. I mean, if they say some more hawkish things about a rate cut, that could also potentially be an impact on market. But the fact that the probabilities are now lower than 50%, I think that's going to define it, guys. I really do. I think that decision will define if we end up having, because Nvidia is going to crush earnings. Big tech has already crushed earnings. It's not like we need Google to put up better numbers than they had a perfect quarter 3 weeks ago. It's part of the reason why, Berkshire probably realized that investing in Google is a good idea. Google right there, 292.24, as that's up 6% on the day. I think it really comes to the labor market now, not really the AI trade. If it's not going to be a rate cut in December, it'll be January. Well, the problem with January is that we have to deal with this whole shutdown fiasco again, which is also very annoying. Micron, by the way, up 5% now on the day. There will be another negotiation starting January 30th, or if we can't negotiate, there will be a shutdown starting January 30th, which is only a couple months away. So that is also something where naturally I think the markets could be a little bit afraid, anticipating that into the end of the year. So that's something I think people are going to have to watch out for. Ethereum right there, 3188, as that was green. Yeah, the 13F filings were before Google earnings, but my point is just like, I think Berkshire kind of, I think Berkshire has a lot of smart people that work there, and they probably did some work on Google, and they probably had a feeling that Google was going to deliver some of the best Mag 7 earnings. I mean, I think objectively, outside of Nvidia, because we haven't had their earnings yet, the best Mag 7 earnings were Google. And Microsoft was good. Meta was really good, but obviously Meta, the CapEx guide is scaring people. Apple was good relative to Apple's historical performance, but Google just knocked it out of the park. I can only imagine. I mean, when do you guys think Berkshire started studying Google? Because like for example, when Bill Ackman bought Netflix, they spent a year in 2021 researching Netflix. He had I don't know. I think he had an interview at the time. I think he had 25 to 30 junior level researchers at Pershing Square, just day in and day out study Netflix before they finally made the decision to buy, and then they ended up selling at the bottom. But nonetheless, they took a lot of time to make the decision. I think for the past year, Google has been thinking, or Berkshire has been thinking of Google. Probably since 2024, they've had a team of analysts just trying to understand the business as well as they could. And then probably around that 180 to 220 price around Q3, they pulled the trigger of 17 million shares and they bought the Googs. And now I think they're in. I think they're going to be in for a long time. I really don't think it's going to be a quick flip. And maybe they keep adding to the position as well. But it is unlikely for Berkshire to chase a name like that when it's, approaching 3 trillion in market cap, which is what made it such a big deal, I think, over the weekend when it was disclosed. Coinbase right there, 274. That's down 3.4%. Gemini 3 is also launching this week. That's going to be very important. And you got a lot of people excited about Gemini. Duolingo 178. Wow, that's the lowest Duolingo's been. Right? I think that's the lowest of the year for Duolingo. By the way, here's the heat map. As you can see, the market obviously loves Google today. That's one of the only tech names that's green. Wow, dude. They really took Duolingo down to an absolute bottom, 178. 2019, Buffett regretted not buying Google. Yeah, there are interviews with Munger and Buffett together talking about how they missed out on a business they really loved, which was Google. I mean, they had nothing but praise for it back in 2019 when they were asked about it. And 5 years later, they have made the purchase. I do not own Duolingo. Again, I have Duolingo in my stock draft ETF. I do not actually own this stock. If anyone actually read my deep dive, at the end of the deep dive, I concluded it's not a buy, and I gave my reasons for why. But it is pulling down my stock draft ETF. Look, the AI narrative is still hurting Duolingo. It's just that simple. I mean, the numbers, if you looked at their last earnings, there wasn't really a red flag on their earnings. I mean, I didn't go that deep into it, but everything was up and to the right. The only red flag is investors really think that a Google Translate or a ChatGPT is going to take away a lot of the moat, if you think there is a moat, on Duolingo. I don't necessarily believe that's the case after doing my deep dive. I think there is like a lot more to the network effects that Duolingo has along with their proprietary data set. But I don't want to be in a name that has that type of narrative, especially because it's Duolingo. Like it's not the most exciting. It's like language learning. There's a lot of other things that have consumer-oriented businesses that have, you know, massive network effects that are benefiting from AI that aren't as basic to me as learning a language. And learning a language matters. S&P 673 high of day, like that's important, but it's not as important as a lot of other things, in my opinion. And so, you know, that's why I thought that holding on to this stock, because it's not like the cheapest stock in the world. And so if you're buying a stock that has a crappy narrative on it, you got to really believe there's some asymmetric opportunity right there. And, you know, that's why I just didn't want to hold on to Duolingo. Netflix did split. Do you have the split on Netflix? IREN, that's also going green as well. And that's up. Tesla is, wow, Tesla 412. Look at that. Tesla was at 382 on Friday, dude. Tesla was at 382 on Friday as that continues to go green. Oh, close up 3%. All right, so high beta is making a little bit of a turn as well. Amazon, Google, or Meta could duplicate Duolingo in 6-month period if they thought it was going to be profitable. Yeah, see, I don't really agree with that. I think like once you really dive into Duolingo's business, what they've built is not necessarily easy to replicate, even though people think it's easy to replicate. In my opinion, there's a moat there, and it's hard to replicate that, and that's why a lot of the big tech companies have not meaningfully focused on it. However, the fact that they could replicate it and the market feels that they could replicate it, even though I don't think they would be that successful if they really tried to go after Duolingo. Like they would have some success. I don't think they would kill Duolingo though. But the fact that the market thinks they could do that is enough to, you know, have this stock trading at 52-week lows. And sometimes stocks just have bad narratives. Case in point, PayPal. I mean, they are buying back 10% of the company. But Apple Pay and Cash App and Robinhood, you've got all these other fintechs that are growing way faster than PayPal, and you know are just, one could argue, a bit more innovative than PayPal. And the narrative is making a stock that has some of the best fundamentals I've ever seen down 30% year to date. But nonetheless, that's why, you know, there are some opportunity costs in different parts of the market. They could have done that. Yeah, exactly. And Spotify, that's what I wrote in the deep dive as well. Spotify is like, dude, I miss Spotify at $70 because I thought big tech would just eat Spotify's lunch. Like the record labels already give Spotify a lot of shit. And then you've got Apple Music, YouTube Music that could easily take away. But there was something very special about Spotify that allowed it to sustain itself. I don't know if that exists with Duolingo. My gut tells me there is something like that. But, and this is kind of, you know, when you go deeper into it, it's not music. Music is emotional. You know, learning a language is cool, but it's definitely not a necessity. And music's not a necessity either, but people that really listen to their music and they have their playlists, I mean, they'll pay whatever you have to pay per month to keep everything in one place, because music is a very emotional thing for people. And that could be a bit of the nuance. Ethereum right there at 3,200. Intuit is down 1%. Intuit was one of the top 3 names that was sold by hedge funds as of Q3. Nvidia potentially going green, 188.75 on Nvidia, trying to make its run back to 190. Tesla having a really good move. Tesla did get an upgrade this morning to 500 by Stifel. And they said 508 from 483. They said robotaxi progress continues in Austin and the Bay Area, with management planning to expand 8 to 10 metropolitan areas by year-end 2025. FSD 14 appears to be working well. We note a potential pull forward of deliveries that could weigh on fourth quarter 2025. CEO Elon Musk remains optimistic on the long-term prospects of Optimus. Elon did say Optimus could solve poverty over the weekend. And then they increased their EBITDA forecast to about $19 billion and their 2027 EBITDA estimate to about $21 billion. They say Optimus is worth $29 a share. FSD is worth $186. Robotaxi is worth $158. Core EBITDA worth $134. When you add those together, you get $508 on a sum of the parts valuation. And that's why Tesla is going green, 415. Palantir goes green as well. Robinhood very close to going green. Palantir like 20 cents away from going green. It did hit 174. And Nebius pushing 90. Nebius as well. Going green, up 6% right here. Google, is that a new all-time high on the Googs? I think that's a new all-time high. Yep, new all-time high on the Google. There you go, folks. 293.90. Wow. On Google, up 6%. Google just added $210 billion in market cap, 3.54 trillion on the Googs. Bitcoin as well, giving you a little bit of a run at 95.4. I mean, okay, so I guess as soon as the market opened and we tanked, you're getting a reversal right here. I would not be surprised if this reverses back down, but very similar to what we saw on Friday, right? Friday, pre-market's ugly. 930 was ugly. By around 940, market's kind of pivoted. And you're potentially seeing something like that today. Tesla right there, a lot of money coming to Tesla, 415 on the day. I talked about Bill Ackman's tweet last night. We spent plenty of time talking about Bill Ackman's tweet. It was quite the tweet over the weekend. So shout out to it. It had nothing to do with stocks, but it was incredible dating advice. Dell and Nvidia. Dell advances enterprise AI innovation with Nvidia. Okay, so you have a headline right there on Dell. The downgrade on Dell this morning is also upsetting the stock. Morgan Stanley cut them to 110. Dell right there, down 5%. It was down 7%. Yeah, they're basically saying we think they're going to have lower margins. We think they're going to have a worse EPS. They're decreasing their fiscal year 2027 margins by 220 bips and lowering their EPS targets by 12%. And that's why they're cutting their price target by 23%. 144 to 110. That's what's hurting Dell right now. I don't think it's, a lot of people are asking about what do you think about Thiel selling his Nvidia. I think people are reading way too much into it, particularly on Thiel. I know he's a big name, but if you understand Thiel's history of like selling stock, he sells stock a lot. Like he sold a lot of Meta before they became a $2 trillion company. He sold a lot of Palantir before they even became a $100 billion company. Like he is not a fan of holding on to stocks. So yeah, I wouldn't read too much into it. I mean, at the end of the day, you're going to have people that take their profits. Same thing with SoftBank. You know, they took their profits after a long time of holding. S&P high of day, 673.40. But, you know, maybe he's selling because he thinks 5 trillion is too much. You know, that could be an argument as well. He thinks 5 trillion is unsustainable. If you look at Nvidia's earnings growth, it trades at 27 times earnings for 2027. I mean, that to me just does not feel incredibly expensive or bubblish. But they've got to live up to the earnings growth expectations to continue holding on to this price target as well. Quantum goes green. You're seeing a lot more risk on that's coming on to the market here today. And why is Beeman are down? Well, Ethereum obviously over the weekend did get hit. Is Ethereum going green today? No, Ethereum's still red. A lot of this is going to depend on Ethereum price action towards the end of the year to see if any of these crypto names move. I mean, same thing with MicroStrategy and Bitcoin, obviously. Oklo going green as well. A little bit more risk on appetite, 100.65. That's up 3%. SBET's up 2%. They had earnings last week, 11.10. And then Amazon, 233. That is slightly red. Do you like Zeta or Delo? I don't know enough about Delo. I do think Zeta is cheap. Like objectively, I think a lot of the metrics on Zeta going up into the right are exciting. But Delo had a great earnings. I don't know why they were down on their quarter. I mean, they had a pretty good earnings. Delo right there up about 1.1%. But I do think Zeta is relatively cheap. SoundHound right there, that's down 1%. Open Doors down 2%. Beyond Meat's up a little bit. Webull continues to get just destroyed, dude. This thing was barely holding above 11. Now it's barely holding above 8, down 2.2%. Big Bear, again, they beat on the top and the bottom line, but they're growing negative 20% year over year. It's hard for me to understand the excitement around a AI company that's not growing. I mean, whole point of AI is to grow. like it's the next industrial revolution, and they're growing negative 20%. So I think that's why that one's getting hit. But obviously, it's very high beta momentum. So if that comes back, you could have a reversal. McDonald's right there, 305, then Coca-Cola, 7104. That's flat as well. SBET, that's up 1.6. Bitcoin, 94.6. Where is ETH? Are we actually red on ETH? ETH, I'm seeing red, down 1.1%. Very small candle, but a little recovery from the low 3100s. Okay, so that's what we got on some of the price action. Let's see some of the other headlines we've got going on. Let's see if we get any macro data today. We did have Canadian data. Let me pull that up real quick. Canada CPI, 2.2 versus 2.4. So you got Canadian CPI year over year coming down. Core was 2.9 versus 2.8, a little bit higher on core. And then month over month was 0.2 versus 0.1, a little bit up month over month. So you are getting Canadian inflation a bit more under control, which is not too bad. We talked about the Japanese. They are printing $110 billion. So that's going to be a lot more for Japan in terms of their stimulus, which could have an impact on the yen carry trade. I do have a video of that high IQ Bitcoin dude giving out his price target. So I've never heard this guy speak. So, I mean, let's take a listen to him and have him give us a good price target on Bitcoin.
As world's high-tech record holder, I expect Bitcoin is going to $220,000 in the next 45 days. I will use 100% of my Bitcoin profit to build churches for Jesus Christ in every nation. As world's high-tech.
Okay, so this is the highest or the smartest man in the world as measured through the highest IQ. And 220,000 the next 45 days. Dude, if Bitcoin, I mean, if he's right, we all got to give him a lot of praise. 220 in 45 days. That would be pretty well. That's my quant, dude. That is my quant. 94,628 on Mr. Bitcoin. MicroStrategy getting a little bit of love. BMNR still down 2.2, and then Nvidia trying to go green. 71% of you said yes, we are still going to have a Santa rally. So 71% still feeling rather optimistic that the Santa Claus rally will end up taking place. By the way, 60 Minutes did a great piece on Anthropic last night, and I was watching some of it, and it was quite incredible. Anthropic has literally trained Claude to be a business owner and manage a vending machine inside of the headquarters. And it's kind of crazy how the AI was talking about like replicating a CEO, right? And having to deal with all the implications of being a business owner. And at one point early on in the journey of starting this vending machine business, Anthropic actually, like, they shut down the business because they went 15 days without sales. And so the AI was like, hey, I need to shut down my business because I'm unprofitable. But they paid for some subscription that was still getting charged to the bank account. And the AI contacted the FBI to report an illegal cyber hack of their business based on this like $5 a month ancillary subscription that was still getting charged to the bank account. And it was just kind of crazy how intense the situation became based on how the AI was thinking of the business. So obviously the AI is not really good at managing a business, because you wouldn't call the FBI for forgetting to cancel a subscription. But the point is, it's getting better and better and better. And Anthropic is really focused on training and looking at the guardrails of how this is playing out. I mean, it just goes to show how crazy this AI is going to become over the coming years. And the other thing that, Dario, the CEO of Anthropic, mentioned, he's not backing away from this statement. He said 20 to 40% of white collar jobs, entry-level jobs, will be gone in the next 5 to 10 years. Sam Altman has not said anything like that, because obviously I think Sam Altman doesn't want to scare people. And Dario was actually one of the researchers at OpenAI in 2021. He left to start Anthropic because I think he was, and this is been said by many other people that left OpenAI, I think he was annoyed that Sam Altman was not pessimistic enough on the downside effects of what AI would do for society. So in the face of it hurting his business, you got the Anthropic CEO clearly saying that AI will take away a lot of entry-level jobs. And the implications for society is yet to be seen, but he is saying that is possible. Micron right there, 257, then Nebius, 88.54. That is green on the day. If AI can run a whole business, it gets kind of crazy. Well, the AI is getting better. I mean, because that was in the early days of starting the vending machine. Now the AI can actually track their P&L statement, actually do customer relationship vendor management. I mean, there's a lot of improvements that they were showing they've made. But eventually it's going to get good enough to run its own business. It's going to get good enough to do a lot of things. Opendoor down 2.8%. And that is something that I think is going to be really important for the entire market to kind of grapple with when that does take place. Retail and tariff update. Let's take a look at what we've got going on here. Again, Trump did roll back a bunch of different tariffs. We have some of the construction spending data. So let's take a look at this. And then let's get an update on some of the retail tariffs that we have going into this week.
Consumers into the holiday shopping period. I mean, this is a heavy week for retail reporting. Starts with Home Depot tomorrow, Lowe's and TJX and Target on Wednesday, Walmart, the big one, on Thursday, along with Gap and Bath & Body Works, Dick's Sporting Goods, which has been a good performer. Because we want to know what the heck is happening with the consumer. There are questions about affordability. There are questions about auto delinquencies, as we've seen in some of the data, questions about slack in the labor market. All of that, perhaps why the White House did go through with something we were looking for and they were teasing last week, which is tariff relief on certain agriculture products to try to make it a little bit easier at the grocery store. So what's included in some of this tariff relief rollback? Coffee and tea, beef, bananas, oranges, and tomatoes, cocoa and spices. And these are some of the products where we've seen the heaviest increases going back a few years, but those price gains are cumulative. They don't come down. And so people are still really feeling the shock of these higher prices at the grocery store. Interestingly, Bank of America put out a note saying who would be the winners in the consumer space of some of these tariff rollbacks. Some of the companies that have had to deal with a lot higher costs on some of these products. In coffee, Smucker, Kraft Heinz, Keurig, Dr. Pepper, they say will be winners from this new policy. Spices, McCormick, cocoa, Hershey. So some clear winners in the corporate space. And then, of course, the White House is hoping that makes things feel a little easier for consumers, too. But obviously, to our discussion earlier, inflation is broad. And there are other pockets of it. They're worried about housing inflation as well. That's why they're pitching this 50-year mortgage rate, whether that works or not, or whether that's feasible. You can tell they're clearly thinking about it.
Right. In addition to direct stimulus, Bessent once again on the weekend shows talking about the prospect of a $2,000 check, which kind of confusing. It might take the form of existing tax cuts. You're going to need Congress. There's been some pushback there, but they're definitely on the affordability kick, as you mentioned.
Yeah, they're going to need Congress for that.
They are going to need Congress for that. This whole 2,000 dividend is not going to just get printed out of thin air. I mean, technically it might, but you're going to need Congress to approve the printing of it if it does take place. Amazon right here, lows of days. Amazon potentially breaking 230. It did for a second, 229.81. But again, this affordability argument continues to be very important for the administration, and it seems like they're focusing on this. S&P very close to going red on the day. So whatever little pump that we got about 10 minutes ago, potentially reversing, and that's kind of been the story of the past couple of weeks, going up, going down within about 30 minutes of itself. We talked about it this morning. I think this is the reason why pre-markets went red. I mean, there's probably some other reasons, but I think the difference between last night and this morning was this headline. Amazon kicked off a 6-part US dollar high-grade bond sale. They're only raising $12 billion, which is, a couple pennies for Amazon. But, they're raising money from the bond market. And I don't think the stock market likes to see these companies that pretty much financed all of this over the past couple of years without the credit markets now tapping the credit markets. And, I was looking at some stats over the weekend. If we did not have the CapEx boom, Tesla is still holding 415, that we had over the past couple of years, like 50% of our GDP growth And some economists are estimating more than 50%, but at a bare minimum, 50% of that was CapEx. If we didn't have this CapEx spend, we'd be in a recession, at least in the United States. Like there would be no exciting momentum. And that's, pretty obvious, right? Like whenever you have any level of massive stock market boom or GDP growth, it's through some industrial investment. So all the AI CapEx stuff it makes sense for it to be correlated with that. But if that didn't happen, it just goes to show where the economy would be. And so that's why I think Nvidia is one of the most important earnings of each quarter now, is because Nvidia is the epicenter of all that GDP growth through CapEx being manifested. And that's why they've got to continue to put up good numbers. And I think Nvidia will put up really good numbers this week. It's just the labor market is a lot more important. And I think that's what people care about. Austin says other industries tap credit without a problem, but if tech companies do it, everyone freaks out. Yeah, again, I don't understand why Amazon raising $12 billion is scary, but nonetheless, the market hates it. If anything, the tech companies have the best balance sheets to be able to pay it off compared to other business models, but market still doesn't love it right here. Why is Nebby's down after every earnings? Every analyst upgraded the price after. That's a great question. It's a question I ask myself around a variety of stocks. The answer I think I can give is that Nebby's is stuck in the data center bucket. And right now, the data center bucket, because of Oracle's credit default swaps spiking 200 bips last week, I mean, it's just not pretty, right? You got a lot of investors buying protection because they think that Oracle or some of these other data center players are going to default on their bonds. And that's hurting a lot of these other companies that are using debt to finance the data center build out. Even if their debt profile is relatively strong, like a Nebius, you're going to get lumped in to that category. ARM, that's up 1%. Micron, that's still up 2.8. Robinhood, lows of day, 117. Robinhood, I think, is going down because of crypto. That would be my bet right here. Bitcoin below 95, and then Ethereum below 3,200. Rocket Lab, are we holding at least 40 on Rocket Lab? 43.82. The lowest it went to was 41 last week on Rocket Lab. And now we're at 43. That was, I think, another concern a lot of us had on Friday is like, was that a sympathy bounce that we got on Friday, or was that anything structural? And it really did feel sympathy. Like it just felt like the market was not going to let it go that low when we were at 663. But it didn't feel like there was some amazing headline that got the market to feel super secure about the state of labor, the state of data transparency, the AI trade, yada, yada. And so I think the choppiness continues until Nvidia earnings, potentially, and until we get some more of this jobs data, which could flip the probabilities for a Fed cut from less than 50% to maybe above 50%. Wow, Nvidia, lows of days, 186.70. 186.70. 10 a.m. slam every day. Yes, 7 a.m. for those on the West Coast. Look, the jobs data, by the way, I think we all know it's going to suck. It's not going to be good. But I think we just have to rip the Band-Aid off. And we have to, the market has to see how bad it is. And then the Fed has to see how bad it is, because the Fed apparently needs to be spoon-fed like a baby, the data. But once they finally see it, maybe that will be enough to say we need to cut rates. But that's going to take another couple weeks until we get that data. SoFi right there, 27.35. That one continues to go down 1.65%. VIX coming back up. That's correct. VIX is going to big green. Is BM&R below their NAV? I don't know. You have some people saying yes, other people saying no. I think it's closer to being below than it's not. But we got to get this share count update. And we got to get an update on why they haven't staked their Ethereum. I think those are the two biggest questions BM&R shareholders are looking for. It's like, why aren't they staking yet? And there might be a legitimate reason why. I don't think it's been properly answered. And then two, how many shares outstanding exist on this company so we can calculate some basic metrics. I think you're going to need those things to get a lot more people to understand what's going on with the name. Google right here, losing 293, but still holding 5% on the day at 290. MSTR is below. I don't think MSTR is below its NAV, is it? We can go on their website and immediately find out because they have everything there. No, it's at 1.19. That's per what I'm looking at. 1.19. It's getting close, but not below their NAV yet. See, this is what BM&R needs on their website. They just need something like this. Just like lay out all the facts. Very simple. And then I think you get a lot more transparency. Granted, it might not be updated, so that's why you guys are saying it might be below 1. I think we get jobs data next week. Next week is what we're looking for this jobs data. And once we get that, we should have a much better understanding of kind of what's going on here.
Is key. Just as far as overall, there is a lot of negativity, and certainly the consumer discretionary stocks have traded down into the holiday period. There is this great chart on holiday spend so far, and again, it's very early. It's not even Thanksgiving yet, but 2025 is obviously the line that doesn't go all the way to the end, and we're actually tracking pretty decently so far compared to last year and the year before. There's the spikes into the holiday of the last few years, which were strong years. So if we can keep at this pace, all things should be okay, and certainly better than feared. We'll continue to monitor things like that, but that's from Bank of America, which looks at everybody's card spending data.
And I think NRF has had some pretty bullish forecasts too for holidays.
NRF is largely positive as well. I think the problem is a lot of it is being driven by the high-income consumer. I mean, that's where the spending is done. About half the spending in the country, and they're benefiting from the higher stock prices and everything, because we've done a lot of charts lately showing the gap between high income and low income, who gets hurt harder on inflation, that don't participate in the upside of the stock market, that get hurt harder when wages aren't going up as fast.
Right.
So that's been the issue. But overall spending has held up because of that.
Indeed. Let's turn to the markets. Kind of mixed here in early trading. Our next guest has an op-ed out in the Times today comparing the current U.S. economy to a Jenga tower that's propped up by spending from wealthy consumers and AI companies. Joining us here this morning at Post 9, former Bridgewater Chief Investment Strategist Rebecca Patterson is back. It's great to see you, RP.
Good to see you.
So Jenga doesn't sound too good. Can you talk about it?
Sure. I mean, the Jenga tower could keep getting taller before it topples. We know economic cycles, eventually it topples. What spurred me to write this is when you think about the supports for the economy right now, as you just said, AI and the high-end consumer, it's kind of it, right? Where small businesses have gotten hurt.
By the way, she's right about that. I mean, AI and the high-end consumer is what's propping up the economy. I don't even think there's a debate around that. There's not that much going for this economy besides you got this massive AI spend, and then you have the wealth effect that's leading to people buying stuff because their stock prices have gone up over the past couple of years.
They're 97% of all importing companies in the United States. So they've gotten hit by tariffs. They're cutting headcount. They're getting harder hit on sales. All companies are cutting back on labor generally, so that hurts consumption, which puts even more pressure on the high end. So you're seeing more of the supports for the economy just getting wobbly or being pulled out, which means that we're riding on a very narrow support, which at the end of the day is AI, directly and indirectly. If it holds up next year, there's no reason why it can't. We're going to have another okay year. But
so asset prices staying high, affluent customers, and the AI spend. Can any of those things go away and we'll still be all right?
No. That's the problem, right? So if the AI CapEx hits constraints, whether that's power constraints, labor constraints, whatever it is, that would be a big shock to the stock market, given that they're driving so much of the stock market. Stocks come down, that affects the high-end consumer's ability to spend. But even if AI is fine, let's say there's something else that causes high-end consumers to get more cautious. Maybe the Fed doesn't cut as much. Maybe it's geopolitical. It could be anything. If they get more cautious and aren't buying equities or decide to take some profit, that pulls down the stock, which hits AI companies in a bigger way, right? So all of these things are linked together, and you need all three of them to stay firm for this party to keep going.
I would add a third one. I've been trying to make this point, which is the Fed and easier policy. The Fed has the same data that we do, showing that the pillars, what's propping up this economy is AI spend, high income consumer. Therefore, how do they justify not cutting interest rates where the rest of the economy is hurting and weakening.
Yeah, I mean, you guys watch this just like I do. The labor market, you've got mixed signals, right? The Challenger and Gray layoff announcement report was scary. I mean, that was the worst report we've seen in a couple decades. But then you look at weekly jobless claims and they're okay. So how is the labor market just softening and we have less hiring, or is there something more sustained and dangerous
But
that
even if
could
it's just
come?
less hiring, why wouldn't they make policy easier in that environment?
Well, because inflation is still a point above where they want it to be, and they don't want to lose inflation credibility. And as we go into next year, we already know we're going to have higher electricity prices, higher medical prices, higher insurance prices, and companies are telling us they're going to pass through more tariff prices next year, despite Trump's latest moves on food and stuff. So inflation, it's not clear. I mean, I know Jefferson, I believe, came out this morning and said, okay, we're making progress. I don't think the Fed is convinced that we're on a steady track to get to 2, which is why there's so
But isn't it easier
much
to
dispersion.
reverse course on inflation and stop cutting or raise rates if they have to on inflation than if they lose the job market?
If we hadn't gone through 21, 22 with inflation getting away from the Fed and them having to adjust, I think that would be the reaction. I think because of that instance, they're probably a little more scared. I don't want to use that word because more cautious about taking that step now.
Look, I think there's some fair points right there. I think 1000% she is correct that the economy is being held up by asset prices that have appreciated, which a lot of us here are the beneficiaries of. And that's why we've potentially made different purchases, which have helped fuel the economy. And the reason those assets have appreciated is because of 2 letters, A and I. If anything breaks on those 2 narratives, aka asset prices go down, even if AI stays strong, you're going to have people probably not spending as much, and that's not going to be subsidizing the lower end consumer that's already not spending. And then if the actual AI trade gets hit, which that I really am not as concerned about, just given the data, given the earnings guidance we've seen, obviously that could hurt stock prices, and then it results in the same effect of not spending as much. So those are 2 really important parts of the economy. It goes back to this whole bifurcated argument, but we need the data to have any level of reasonable analysis on how bad it is. Because as she said, even if the jobs report is bad, but jobless claims, for example, are nowhere near recessionary claims, which is around 350,000 a week, if we're still stuck at around 240, 250, that means the labor market is weakening, but it's not deteriorating, which justifies a cut, but it also doesn't justify a panic because unemployment is going to like 7% anytime soon. We're still only at 4.5% for unemployment. I think the number one thing, though, is if the Fed is really stubborn about this 3% versus 2% inflation target, then, that creates a lot more complications on if they're actually going to give us this cut. Rock Lab continues to get hit right here. Rock Lab 43.63, got to 43.60 at the lows. That's down 4%. Tesla somehow holding on to green. I guess the market got excited by some of the upgrades this morning, but Tesla is still above 411. Fed President Jefferson says, do not think crypto and other innovations will influence the Fed's ability to do monetary policy as long as the Fed keeps pace with what firms and households want to do. Yeah, you got a lot of these Fed presidents that continue to be pretty damn bearish on a rate cut. I just can't believe it flipped this quickly, dude. Like it flipped so quick. Like less than 3 weeks ago, Robin, a low of days 117. We were all looking at a guaranteed December cut. And I know Powell came on the FOMC and he said, hey, don't expect a December cut. We're still looking at all the data. But it went from we're looking at the data and all of us being like, okay, sure, we get it. You have to look at the data, to like, yeah, we're likely not going to cut. I mean, they haven't explicitly said that, but that's basically what they're saying. And I guess you're going to need some pretty important data to switch their mind. But dude, S&P 7,000 without the cut is just tough. Is it possible? Yes. It's just a little tough. BM&R down 4% right there. And then again, what are the reasons why I think asset prices have really taken a bit of a breather over the past couple of weeks? It comes down to this idea of a fundamental shift in the economy around the lower end consumer really starting to make people wonder, is it enough to expect the earnings growth that we've seen over the past 2 years if more and more people say we're going to stop going out to eat, or we're going to, not take out a personal loan because we can't afford to pay the interest on it, or we're going to go delinquent on credit card debt. I was showing these charts last night, and these charts have been pretty consistent over the past couple of months. Unfortunately, delinquencies are rising, and there's no way to kind of deny how much they're rising. And again, it's on the lower end of the consumer. These are percentages of balances that are 90 days plus delinquent. As you can see right there, 12.4% of credit card balances are 90-day delinquent, highest since 2011. Auto loans hit 5% 90 days delinquent. That's highest in 14 years. And then student loans, 10% delinquent, the second highest since 2020. Like, I don't know how the Fed looks at that and says inflation's the bigger concern. I mean, this in and of itself is deflationary. If you have a lot less people putting money into the system and obviously a lot less demand because of the delinquencies on existing loans, you're going to get a natural decrease of prices. Now, the tariff stuff complicates it, and that's why Trump is pulling back some of the tariffs, which is fair. But obviously, I think this is the biggest issue in the macro right now. Pounds right there, 170, and then Google at 289 on the day. Tom Lee better leave the country soon. Oh, man. Look, when you're a public figure and you publicly pitch a name and that name gets hit by 50%, obviously you're going to get a lot of shit for it. I just think they need to be more transparent about basic things like how many shares they have outstanding. I mean, I at the end of the day, people can blame whoever they want, but they have to blame themselves for their own decisions, which is fine. It's just, I think a little bit more transparency would help. And then, he needs to be right on this thesis that crypto is deleveraging right now, which is why you're seeing the pain, not that we are entering into a structural bear market, which I don't even think Tom knows. I mean, like at the end of the day, everyone's just making their best guess using the data that they have. And his argument is that it's a structural deleverage, not necessarily a beginning to a bear market. And at the end of the day, crypto is volatile. So crypto being volatile is going to lead to volatility up or down. Tom Lee buys a one-way ticket to Mars. Oh my gosh. Google right there, 289. That's up 4%. We're not seeing a ton of weakness on the indices. S&P is down 27 cents. I mean, there's nothing real there that's going down. But some of these other names are still getting hit.
Rebecca, I feel like we could have made this allusion to a Jenga tower any number of times over the last 25 years. I mean, is there anything in particular that distinguishes this period from others where we might have similarly said, well, it's relying on one or two different things or three different sectors and not, broadly speaking, sort of a robust economy?
Well, I think we've had some big market pullbacks that were the result of similar Jenga towers. So when you think about the fracking and the shale revolution build out for the oil market, and we had huge spending, and then suddenly they were borrowing too much, and investors said, wait, we changed our mind. We don't want production. We want strong balance sheets. That was a baby Jenga tower collapsing.
Although it didn't necessarily impact the broad economy.
No, that was more
as much as perhaps AI making a change in trajectory.
100%. But I agree. That was more of a sectoral issue that had some implications for parts of the economy. I think what makes this one a little different is the degree of the concentration, such a small number of companies driving the overall market, and the reliance on that high-end consumer. Again, it's more degree. We've always had inequality. We've always had disparity, unfortunately, between higher and lower. But I think the degree of that disparity, when 10%, the top 10 income earning cohort owns 87% of the stocks, that's pretty extreme.
You're right. A lot of the charts, the bubble charts, are rails in the 1880s,
Right.
Telecom in the 90s,
Yep.
shale,
Yep.
and AI.
Yep.
And it's all
I
sort
think
of concentration.
if we're looking for optimism, what gives me optimism that we could have another year of tower building, so to speak, is that the leverage story for these AI companies is fairly nascent. right? Most of these companies still have really good balance sheets. The amount of debt that's getting issued, it's getting a lot of headlines, especially some of the structured stuff. But at the end of the day, we're not talking about huge leverage in the overall system. So that gives me encouragement. The amount of buybacks certainly is a case for optimism. The tax refunds that consumers will get next spring, now that's tactical. It's a couple months of more consumer spending probably, but it's consumer spending. So I'm not saying the tower is going to collapse tomorrow. I'm just saying whenever you have a concentrated support for an economy or a market, that should be kind of the yellow flag to start thinking about risk management.
Does any of this explain the underperformance of ex-US stocks this year, which is the worst in a very long time, several years?
The underperformance of ex-US?
Of the S&P versus ex-US MSCI, however you want to look at it.
I think yes. I think there's an element there just because the valuations of U.S. companies had gotten so high. Investors are looking for better value elsewhere. And then you had some stimulus, partly thanks to President Trump, right? He lit a fire under Germany. He lit a fire under Canada, a number of countries to do more. And I think that's the valuation plus some more stimulus in certain economies and steps in those economies have made their equities look more attractive. And the AI, spread your bets. Why is the Chinese market doing so well? It's the AI companies. Why is Germany doing well? It's SAP. Netherlands, it's ASML. So,
Korea.
Right,
Korea
exactly.
that's
right.
Is there going to
exactly.
be a tell in this market, Rebecca, that says,
time to get out?
Well, somebody's really starting to pull that block out from the tower. Yeah. Is it going to be the bond prices of certain companies? Or I don't know. I'm just curious.
People looking at Bitcoin,
Yeah, well, I was looking at Bitcoin. I don't know is the answer to your question. If I knew, God bless, I could, I'd be done.
You'd be killing it,
yeah,
man, without a doubt.
But I think Bitcoin is one to watch, actually, because look, Bitcoin itself is not going to bring down AI, but a lot of the same retail investors are in both things. And to the degree that levered bets in crypto are causing margin calls and they have to take profit elsewhere to cover those, all else equal, that's going to be a drag on some of the
100%. I mean, at the end of the day, if you're leveraged crypto, you're getting margin called. You might have to sell some of your Nvidia to deal with the margin call. And, that could be creating pressure on the broader US stock market.
Tech companies.
Yeah, Bitcoin bouncing off 92.9 this morning, but
it's been a big move.
Yeah, very big. Was 126?
Yeah,
just a few
weeks.
I think that's a real story, dude. I think people are the idea of these perpetual futures contracts and the overall S&P going green, by the way, again, all of the interest of leverage that has gone into crypto. I mean, I've never levered up a crypto contract. I barely understand the dynamics of a perpetual futures contract. I think I understand it at a high level, not at a serious level to actually, go leverage long on a contract. But people that have been super leveraged on that, if they got liquidated or they got hit with a margin call because they thought ETH was going to 7,000 or Bitcoin was going up like crazy, I mean, obviously they're going to have to make up for the money somehow. Now, do I think every retail investor is trading perps? No, but there's significant more activity in the retail investor space at the intersection of crypto over the past 4 years. And so you probably have a lot more people that are at least interested and they dabble in it. And maybe they have a couple winning trades and then they get, a little arrogant and they take on some more riskier trades and then they get margin called. And they might have to end up selling some of their Amazon or SoFi to be able to deal with that. SoFi right here down about 1.6%. Amazon 230. That's down 1.6% as well. It's deleveraging, just like how the yen carry trade caused the wide sell-off. Yes. Now, the problem is the yen carry trade was done within 2 hours. Like literally, the yen carry trade finished within a couple of hours. Like we barely were. We were down 10% on the S. I remember that day. We hit 507 on the S&P. That was a 10% move intraday for like 2 minutes. And then it was just a straight V-shape higher. This crypto deleveraging has lasted for almost a month and a half. I mean, you could say it started on October 10th when you had that $20 billion liquidation. And then since then, it's just been down, down, down. So I guess some deleveraging events take longer than others, but it doesn't feel like the yen carry trade because that happened and then you moved on. This one just feels like there's more and more, in the words of Jamie Dimon, cockroaches that are popping up. And, that could be creating some more pain. The good thing is ETH has held 3,000. It almost broke that yesterday, but it's held it. And then Bitcoin, at least holding 90,000, I think, is something that is more beneficial than not. Tesla right here, high of day, 417. That's up 3%. That's up 3%. I don't know why Nebius and Iren are ripping today. Honestly, you would expect them to be down when Nvidia's down. But they are old. I mean, maybe the Google $40 billion Texas data center investment, maybe the Amazon raising $12 billion of debt is kind of bullish for some of these neo clouds. So you could just say the data center trade is getting some love today, but I don't think there's a specific reason. Now, CoreWeave, again, the debt profile on CoreWeave versus Nebius and Iren fundamentally different, but that one getting hit as that one's down. The other big news story over the weekend, and I haven't fully dived as deep into it as I need to. I'll try to do it today, but the Fed did have an emergency meeting with a bunch of different banks, and the Financial Times reported it. And to the extent of what I understand from that emergency meeting, it was more about concerns around liquidity and the broader solvency of liquid assets in the banking system. And a lot of it hinges on the idea of, do banks have enough money to be able to handle any cracks in the system? And again, the reason I think that these meetings are taking place, and the Fed they did it in an emergency way where they didn't have to fully announce it, so it was kind of under the radar. But the kind of point of the meeting, I think, is that the Fed is seeing the same data that we're seeing, which is auto delinquencies, credit card delinquencies, and student loan delinquencies being at their highest level ever. Remember, JP Morgan, I was looking through their earnings statement last week. Their credit for provision losses was $3.4 billion. The market only expected them to come up with $3 billion. So they allocated another $400 million in case they have to take losses on default loans. Now, if they didn't allocate those extra $400 million, they would have been in line with expectations, so the market wouldn't have hated them, and they would have boosted their earnings by an extra $400 million bucks. But they decided to be more cautious because, as per Jamie Dimon, he thinks there's a lot of cockroaches in private credit, and there's a lot of loans that are not necessarily being given to the right people. And he's a bit more cautious on kind of what's going on in the broader credit ecosystem. I think it's worth, and I will try to do as much research as I can over the coming weeks, diving into kind of what's going on with the credit ecosystem. I don't, the article didn't say that this is 2008 or anything crazy like that, but they did say that there might be loans being given out across the board that probably shouldn't be given out. And that in and of itself could cause some fears in the broader economy. Not fears to the point where the markets just completely collapse, but definitely fears where, markets don't go up as they were over the past couple of months as easily. So I think we're going to have to see, but that Jamie Dimon cockroach comment, I mean, as soon as that comment came out, you had markets go red. And since then, that comment really has stuck with a lot of people. And now you have a lot more people thinking about what's going on in private credit. CoreWeave right there, still down 2%. Tesla 415. Bitmine down 5% on the day. Are we at extreme fear? Are we actually at extreme fear? Yeah, and then the Fannie Mae not requiring credit check anymore to buy homes. I mean, that's not exactly true, but there's rumors out there that Fannie Mae is going to really loosen credit requirements. You have the 50-year mortgage. You have a lot of this shit that's just it's not smelling good. A 50-year mortgage, really? No. We are at extreme fear. We just went to fear 26. We were at extreme fear for a second. Any basic economic analysis of a 50-year mortgage would tell you that it's not worth being in debt for another 20 years, especially when most people are buying their homes now at an average age of 40, not 28 like it was 2 decades ago, for $200 less on your monthly payment. In what world does that make sense? $200 less on your monthly payment, an extra 20 years of interest. It is so stupid, objective. Who actually thinks that makes any sense? But the fact that that's being floated around is really getting a lot of people to call BS on, some of the things that are going on in the economy. And obviously some of the things that are going on with the affordability argument. Yeah, it's very loan sharkish. Agreed. So I think those are all the reasons. Those are at least some of the reasons for why we are seeing a narrative shift in the sort of bull market momentum. And then crypto going down doesn't help, right? As a risk on asset. Granted, The AI trade, I think, is very real. Nvidia earnings are very real. The progress we're seeing in AI is very real. So you have a lot of things that are combating that. It's just again, this sort of bifurcated economy going back and forth against each other. And the linchpin of all this is the freaking Fed. If they can just cut and like give a little bit of relief to consumers and to businesses. But because that seems unlikely, that is the issue that we're seeing right now. Here is one of JP Morgan's analysts, and here's his argument for why we are not in an AI bubble.
The U.S. economy is gliding into year end in a pretty good environment right now. Corporate America seems to have absorbed the tariffs pretty well. The consumer's doing pretty well. We do expect the Fed to come in and cut rates in December. That would be a nice tailwind as we head into 2026 and the One Big Beautiful Bill Act hits.
Right. Okay, here's a timing question, though. And I've been talking all the morning about this study that I looked at, a chart, actually came out of JP Morgan, one of your analysts had put together, showing if you put money into the market at, I think it was 23 or 24 times price to earnings ratio. Historically, 10 years later, you'd look back and you'd say that you only were really benefiting in terms of I think it was up 2% on an annualized basis, your return, or down 2%. It was somewhere in the, it was one of those scatter graph charts. Have you ever seen those?
Yeah.
So the question is where we are right now in the cycle. If you were to put money in the market today, whether in an index or something else, and then you and I were to go and have breakfast together in a decade from now.
I think you're going to look pretty good. I think you have to appreciate that there are some secular changes underway. Technology, of course, is a big one. You have to look at demographics. The 1991 births are now the largest demographic. They're 34 years old. They're dominating earning, spending, and saving. You've got, I think, a pretty stimulative macro environment. On the fiscal side, pretty much every government is borrowing and spending. And in the US, you've got easing central bank accommodation and probably some regulatory tailwinds as well.
So we've got Nvidia coming up this week. That seems to be like, the thing everybody's focused on. Would you be doubling down on the Mag 7 or the Mag 10 or whatever you want to call it? Or would you be doing something else?
Tough question, but I think you have to look at where the money's going. And right now, every company we talk to, and we extend a lot of credit into the system, everyone's gearing up for CapEx next year.
Right.
They're looking to ramp up some hiring. They're looking to build out whatever they're doing in AI. They see the effectiveness of it. They want to spend in that area. And of course, they're going to spend at the biggest producers in that space.
Do you worry about the credit issues that you said extending credit into the market and given the CapEx spending? There is a question about CapEx spending and whether it's actually too much in this space, given the economics of the folks who ultimately are going to have to pay for it.
I think this is one instance where you can look back at the dot-com era and recognize that a lot of money will be spent in areas that will be fruitless, and a lot of money will be spent in areas that will bear fruit.
Right. But so what's the lesson, though, of the dot? If we go back to 1997, 8, 9, what is the lesson of what an investor is supposed to be doing if that is the corollary?
The lesson of the dot-com is there was a bubble, it burst. We don't think we're in one now for AI, but companies didn't stop spending on Wi-Fi, the internet, and technology. Can you imagine if every company out there said, right, I told you so. Look at stock valuations. They're down. I'm not going to invest in this. It's a hoax. Ridiculous.
Okay. Bob, I want to thank you for coming in this morning.
Always a pleasure.
Again, the sort of macro tailwind argument is intact. I think no one's arguing with that. It's a question of the short-term volatility, and that's why we're seeing a little bit of that volatility into the markets. Here's the update on Google and Berkshire as well. By the way, Hood 5% down, 116.34, really getting hit today as crypto continues to get hit as well.
Value invested stock picks, and Alphabet at nearly 29 times forward earnings might not immediately come to mind as a potential target for the firm. However, as my colleague Yoon Lee points out on CNBC.com, Alphabet is actually trading at a lower multiple than many of its AI-driven mega cap peers, such as Microsoft, Broadcom, and Nvidia. The Alphabet investment is unlikely to have come from Warren Buffett himself, who is stepping down as CEO at the end of the year. Rather, it may be either Todd Coombs or Ted Weschler, who spearheaded the decision. The stake is a sizable one, though, 17.9 million shares worth about $4.3 billion at the end of the quarter. It's up 19% over the first 6 weeks of Q4, thanks in part to that nearly 5% move today. Google's parent company is now a top 10 Berkshire Hathaway holding and the firm's biggest new tech position since its original Apple investment. Alphabet, Amazon, and Apple together comprise about a quarter of Berkshire's $267 billion stock portfolio. Berkshire maintained Amazon in the quarter, but did pare back Apple by 15%. However, it still remains Berkshire's top holding, worth about $60.7 billion at quarter end. Just a reminder, guys, these positions as of the end of Q3, and they may have changed in the 6 weeks since then.
It's funny, Leslie, we were talking about, or Mike was referencing Code 2, which you also obviously have been covering with these 13 Fs increasing, but Alphabet not having been part of, I think, a report they put out earlier, even though they're not a sell-side firm, obviously, but, in terms of their top 40, and now it's clearly a buy there. Any sense, given I know you just spoke with Philippe Lafon delivering Alpha, in terms of their change of heart?
Yeah, he didn't mention Alphabet specifically in the conversation we had at Delivering Alpha last Thursday. However, in terms of AI and its kind of broader impact, he did express concerns about the impact that AI might have just economically. It was something you were talking about earlier on the 9 a.m., whether it is a real sizable job replacement, what that means for society writ large. So those were some of the main concerns he had about AI. But in terms of Google vis-a-vis other AI plays, he didn't exactly get into that discussion at DA, but more kind of from a macro standpoint where he was focused on with AI.
All right, Berkshire continuing to buy the Googs, and that one's still going green on the day. Tesla holding on. S&P again is flat. Bitmine and Hood getting hit the worst today. SoFi potentially going below 27 as that one continues to go down. And then Amazon right here, 230. Zeta down 4%. Nebius holding on. Nebius, I ran Tesla green in the high beta. Micron also going a bit green. Everything else basically red. Google as well, obviously green because of Berkshire. Yes, Berkshire also owns Amazon. They bought that a while ago. It's just not as big of a stake as Google. Palantir 170. Yeah, Palantir holding. I mean, look, Palantir again trades at a very aggressive multiple, and so Palantir is still green. I mean, a lot of these names, again, Hoodie, I know it's down a lot from 150, but it's up 195% year to date. It's the best performing stock on the S&P 500. Same thing with Palantir, down from 220, but it's up 127% year to date. So obviously it sucks if you bought it super, super high, but then the question just becomes, was that a good buy? And, at least from my perspective, I've not touched Hood above 125 because at some point it just became like, all right, it seems like a lot of momentum here, but not really fundamentals backing it up. And the earnings were great, but still at 150, you need time to grow into that. Same thing with Palantir at 220, you need time to grow into that. And so I think the best thing over the next year is a lot of these names just kind of stay oscillated within a range. It's going to suck for portfolios that are heavily allocated to them, like myself, but it is healthy. It's not healthy for Hood to run up to 170 next year for no reason, or for Palantir to go to 300 for no reason. But I think them holding their multiples and just staying in these ranges is also not horrible. Nvidia right there, 187.76, as that goes green. Doug says Hood is a gap fill down at 101. Okay, so as I do think Hood doesn't deserve to be at 150, I also think it really doesn't deserve to go to $100. So the question then becomes, what's the sweet spot for the street to keep it at? And I guess we're going to have to see. There are prices where things get stupid, up or down. And so I think at 117 to 120, that's a decent run after the S&P inclusion on Hood. I think that's relatively normal for it to stay there. And it did stay there for a couple months until it had that run a few weeks ago. But, getting to below 100 would be I think quite aggressive. MicroStrategy right here, 197, and then Oklo, 100.4. What else do we have? Orbs, is that up today? Orbs, I have not fully understood ever. That's up 8.3%. I mean, again, I think biometric engineering of like identity matters. I don't know if it matters that much. So I've never fully understood the Orbs thesis, but that one is up a little bit today. Nvidia trying to go green on the day, 187.64. Down about 1.3%, and then SoFi still down 2%. What do you think of Webull at 8? I just really don't like the narrative on Webull. Is it cheap? Maybe. But you know, if the street's not going to respect Robinhood's growth by taking away its premium, I don't know if they're going to love Webull's growth. So, I mean, yeah, it could move. It definitely is a heavy retail trade. The institutions are not deep into Webull like they are in Hood. What do you think Webull needs to do to see growth like Hood? Well, again, Hood became a financial institutional powerhouse this year. And I think that's only going to increase next year with the advance of banking. Webull is just a trading app at the end of the day. And so they need their trading volumes to be really good. And if you look in their earnings, they're not that good. I don't know why people think Webull's that, the options growth was 8% year over year. We're in a massive bull market and they're growing 8% on options. How does that make sense? Why is that attractive to people? So I think Webull would have to do a fundamental transformation. And I don't think it's in their DNA to be like a full-on Gen Z millennial institutional powerhouse for finance. I just don't see that easily happening. But then again, it's approaching $3-4 billion market cap. Obviously, that could be enough to get it to move higher. Once BMNR reaches its 5% goal, what then does staking cause the share price to explode? So the only thing that will cause BMNR to go higher is the price associated with Ethereum. I mean, with Ethereum's price, so the premium associated with Ethereum. And so I don't even think staking is relevant, to be honest. I think what matters is the long-term bull case on Ethereum, which more and more every day, all I see is a good thing. I mean, still stablecoin supply on Ethereum is 167 billion out of 350 billion. You're seeing more and more financial institutions choose Ethereum, but the prices are cooperating. I think the broader question should be, why is ETH down with all the progress we're seeing for Ethereum versus why is BMNR down? Because BMNR is down because ETH is down, right? And that I don't fully know. BMNR is falling a lot compared to ETH. Yes, I mean that is the compression of their MNAV, which happens when people get annoyed with the trade, right? We saw this with MicroStrategy for a couple of years before MicroStrategy did the 30x that it did. Like when Bitcoin was in the gutter and MicroStrategy was acquiring, MicroStrategy was not always trading at a premium to NAV. They were just forgotten. And then once Bitcoin made a move, then everyone started caring about MicroStrategy. So I think, obviously the same thing theoretically could play out for Bitmine here. You should say, it's worse than 120, 119. Let's make the dips fun. That's actually hilarious. That's true. What's worse than 120, 117 on Hood is 116. Escalator up, elevator down. Look, I think we're really going to need, Doug made a good point as well in the chat that the implied move on Nvidia is 300 billion in market cap. So about 7 to 8%. Obviously, you have a lot of algos getting ready for what Nvidia earnings will look like. And you have the VIX trading around that as well. So whenever you have Nvidia earnings week, the entire market stops and waits to see what numbers Nvidia puts up. I just think a really good Nvidia quarter with no guarantee of a Fed rate cut might leave us in the same position. Because it's not like this is Nvidia a la 2023 where we're trying to figure out if AI is real. Like that narrative is done with. Like AI is very real. Everyone knows about that. Now it's about, can they sustain the growth? The question becomes, can the underlying economy sustain itself even if Nvidia is growing at the astronomical levels it's growing at? I think that's what the Fed is more concerned about. That's probably what the market's more concerned about. I really don't think this sell-off over the past couple of weeks or choppiness has been the AI trade being into question. I mean, in some portions with the debt financing, yes, but I don't think anyone's questioning Nvidia. I think they're questioning, can people get a job in the world in which Nvidia is growing at 50%? That, to me, I think is the biggest issue. Tom Lee put out a new BitMine video. Let's actually pull that up. I didn't get to watch it yet. They did say that was up there. Okay, so let's pull this up. Let's listen to a little bit of what he's saying here as well.
Olympics, FIFA, the World Cup and rugby, etc. So let's switch to monetary policy liquidity. That could explain things, whether it's the Fed cutting rates, quantitative easing. I think those are in the near term definitely important factors, but do they explain the 4-year cycle? We could look at M2 supply and see if that explains 4-year cycles. In other words, is there a monetary cycle of 4 years? Well, the reality is if you look at the peak of Bitcoin prices, it has not been affected by Fed liquidity. So I don't think that's the explanation. Well, let's talk about retail margin debt. Now, this could explain something because we know retail investors were buying Bitcoin in the early days, and they continue to, but they're not the only source of flows today. As we can see, a lot of this is institutional money. But you can go to FINRA, hit the margin debt, and this is what the chart looks like. So, I think it looks a little cyclical. In fact, if I overlay this with Bitcoin's price, they do look somewhat related. But here's the thing, the peaks don't match up. Bitcoin enters a bear market even as margin debt is still going up. So I don't think margin debt really explains Bitcoin's peaks. So that gets us to copper versus gold. Someone on Twitter posted this named AOBTC Analyst, and I thought it was interesting. This is saying, is there a copper gold ratio marking Bitcoin's relationships? Here's why that's interesting. Copper versus gold is a measure of industrial activity versus a fixed monetary base. So when industrial activity is peaking, that's a high copper to gold ratio. Could that signal a peak in Bitcoin's prices? Well, let's overlay that chart. And if we look at the peaks in that ratio, in fact, it does correspond very well with the peak in Bitcoin prices. So I think that this is actually very explanatory, but look at the current ratio. It's not signaling a top. And let's think about ISM manufacturing along that same line. ISM is really the most important measure of US industrial activity. When that index is above 50, the economy is expanding, and when it's below 50, it's in contraction. So the business cycle peaks are marked here. Current reading is 48.7. So the ISM says we're not solidly in expansion territory. And of course,
Tom Lee's been talking about this ISM argument for a long time, and we've been below 50 for a while. For us to peak in the like a very top to be made, you've got to be massively expanding, and we've been contracting. We've been getting close to 50, but not expanding at the level at what you would imagine would be a peak. So he does have an argument there that there's a lot of business activity yet to be done before you could say that there's some big top.
Nowhere near a peak. Well, how does that compare to Bitcoin's price? If you look at the peak in the ISMs, they do correspond really well with Bitcoin's peak in price. In fact, four times the major highs in Bitcoins corresponded to an ISM high. But ISM is not signaling a top currently. It's still well below 50. So here's our take. I think the halving cycle worked in the past, but I think there's too many things that are 4 years. The monetary policy cycle really doesn't explain the 4-year cycle. It explains Bitcoin in the short term, but not on a 4-year basis. The speculation cycle doesn't really work because it only explained 1 of 3 margin cycles for Bitcoin. But this gold versus Bitcoin versus copper, yes, it does seem to really be explanatory, and it's telling us we're not really near a top because industrial activity isn't peaking. And then finally, when it comes to the business cycle at ISM, I think it is actually quite explanatory, and again, not a sign of a top. So our takeaway is the Bitcoin price cycle actually seems to follow industrial activity and gold. And the message currently is, HODL, I wouldn't be giving up on Bitcoin and assuming the price has already peaked. Well, let's talk about Ethereum for a moment. Now, Ethereum is continuing to trade in this large base as we're highlighting here. But as you know, crypto suffered a massive liquidation on October 10th. And we pointed out that the languishing of crypto prices in the past 2 weeks since October 10th has the signs of a market maker, or maybe more than one, having a problem with their balance sheet. That means they need to raise capital. They're, of course, not taking risk and providing liquidity to markets. And of course, that means sharks are circling because they know there is price vulnerability. They're going to try to force prices down because that would create further problems. And that's where the asymmetry is. Until the market makers fix their balance sheets, and that takes time, sharks are circling. But this is the message to me. I just wouldn't be using leverage. I don't think this means crypto is broken. And in fact, as you can see on CoinMarketCap's Crypto Fear and Greed Index, we're at an extreme fear reading right now. These are levels that you saw at the April tariff lows. So I don't think this is a time to be panicking. And of course, positive things keep happening on the blockchain. This is Ethereum's block space at an all-time high. Of course, stablecoin creations on Ethereum are at an all-time high. And many crypto experts are talking about why Ethereum is really where a lot of people are building. So this takes me back to this fact that I think Ethereum in 2025 is having its 1971 moment. Many companies are building projects on Ethereum, and most of the value in terms of tokenized assets are taking place on Ethereum. And that tells me that Ethereum's price to Bitcoin ratio should start to get to its at least its 8-year average and probably get to an all-time high. And that means that if Ethereum gets to its 8-year average price, that's about 12,000 Ethereum. So Ethereum is really undervalued currently. And if it gets to the 2021 high ratio, that's 22,000 Ethereum. And of course, if Ethereum becomes the payment rails of the future, that's $62,000 Ethereum. So you can see Ethereum at its current prices is drastically undervalued. And that gets us to the third topic, which is tokenization. Now, you've heard a lot of people talk about tokenization, but I want to explain why it's a huge unlock, okay? Larry Fink says we're at the beginning of tokenizing all assets. I mean, he's talking about stocks, bonds, and Vlad at Robinhood is saying the same thing. Now, there's 5 reasons why tokenization is important, okay? It's fractional ownership. It reduces cost and efficiency for managing securities. Therefore, it's better for the investor. It allows 24/7 global trading. You get a lot more transparency and security, and hopefully over time you get increased liquidity. So what does this mean? Well, it means that in 1971, Wall Street was in its earliest stages of innovation. We are here today, 2025, but tokenization on Ethereum is going to take us into the future. So what is tokenization? Let's just take a Rembrandt painting to illustrate. And to tokenize it, we can break it into its components. And in theory, someone could just say if they're doing fractional ownership, they just want to own this part of the Rembrandt. Okay, that is fractional ownership. But you can also factorize on the blockchain. And what does factorize mean? Well, it means taking the painting and then breaking it into its base colors. Okay, and therefore you can do that with a business. Let me give you an example with Tesla and unlocking Tesla by factorizing it. You can time tokenize Tesla. That means you can buy the earnings on a specific date in the future. You can product tokenize. You can buy the present value of a specific product stream. You can even geographically tokenize. You can buy the present value of a regional portion of Tesla's sales, or you can financial statement tokenize. Now, why am I pointing this out? You need liquidity to create these, but you also need smart contracts, a lot of good technology, and a lot of good code. And that's what's happening on the blockchain. So here's an example of time tokenization. Tesla's stock price is really the sum of all future earnings. And we know that, for instance, Elon's going to get a 10-year pay package worth $1 trillion if he delivers value for Tesla shareholders. Well, what does that mean? That means that you may only want to buy Tesla's earnings in 2036 when he gets the payoff. Well, that's an example of time tokenization. Now, there's a second way to look at this, which is product tokenization. Tesla is comprised of the present value of its various streams of EV, robotaxi, prime robots, FSD, solar, and of course, the future, which is Elon's brain. Someone may only want to buy Elon's brain, and therefore a tokenized Tesla is a bet on that versus everything else. So you get the picture. And finally, on digital asset treasury fundamentals, we've talked about this.
I mean, when you pair that together with prediction markets, obviously, I had no idea prediction markets would become as big of a thing as they've become. But this is the first time I've heard tokenization of various different elements of a business, which, with increased liquidity, you would have a lot more people trading that stuff. But you can already bet on things on Polymarket for, 2-3 years in the future. I mean, if that becomes a massive market, along with all the other types of things, you could tokenize real estate, private credit, et cetera. I think that's why you've got people like Vlad getting very excited about tokenization as well.
Many times, so I'll cover this quickly. There are many ways to increase Ethereum per share, issuing stock at a premium, using equity-linked securities, income from operations, earning staking rewards, and acquiring other dApps. And Ethereum treasury companies are crypto infrastructure businesses. Ethereum is a proof-of-stake blockchain. Ethereum generates a staking yield, and staking is securing the network. So it is an important function that one would do by staking. And of course, eventually stablecoin issuers and those tokenizing real-world assets are going to want to stake ETH because they're going to want to have some governance. And that's, again, providing network security. So as you look at our roadmap, we are getting involved with the community.
All right, that's his argument. Not a lot of people are going to care about all that analysis on a day like this, but nonetheless, you can tell with the amount of research and analysis that Tom is doing that there is a pretty sophisticated reason for why he got into this. Will he be right? Time will tell. But obviously, as ETH gets hit, people don't want to hear even anything if the stock price is going down. Google right there, 289. Dell, that's down 6% on the downgrade. Spotify, that's up a little bit. Hoodie, bouncing off 116 on the lows. Got to 118 again. And Tesla's still holding strong, dude. I mean, S&P and Nvidia are red. The fact that Tesla's having a 3% day is really incredible. Really, really incredible. So Tesla right here continuing to go green. Amazon, did we actually go below 230? Wow. They're taking away everything. They're taking away the freaking 20% AWS growth. They're taking away the OpenAI AWS deal. They're taking it all away. I mean, again, a lot of this, I really, really do think a lot of this comes down to the labor market, and we just need more data to have a better understanding of it. I did this poll on Twitter. I'll show you guys the results, and then I'll ask the poll right here in the chat just to kind of get a read on what people are thinking. This poll got 14,000 votes. So do the same poll right here in the chat. But what are we thinking for 2026? So 3 options. Do you think we have a bear market 10 to 20% down, a bull market 15 to 20% up? By the way, 67% of you said we will have a Santa Claus rally, or flat? If we had to pick, what would you pick? Let me pull this poll up in the chat. Bull market or flat? Most people, so 41% of people said bull market, and the next highest was bear market. Is cooked an option? Oh my gosh. Dude, at the end of the day, if the earnings are good next year, we don't have to have a crazy, crazy bull market, but we don't need to have a disgusting 2020. Remember, 2022, again, to remind people, the Fed was hiking, number one. We cannot forget that. You had rates go the highest they've been in 40 years. That was not good for equities. And then number two, you had all this overhiring and glut and fat from COVID, from just like companies that had all this demand because people were staying at home. They had to overhire that they had to get rid of in 2022, which meant the earnings ended up declining. Those were 2 macro headwinds for the economy. I would imagine 2026, we don't have the Fed raising. Now, the Fed not cutting might be potentially just as bad, but at least they're not raising, number one. And then number two, earnings growth is very strong. Now, the labor market could decimate that, but if that's not going to be decimated by the labor market, if it's bad but not horrendous, then, you know, Meta, Google, Amazon, they should be able to continue to grow earnings at a pretty accelerated pace, which is why I don't think it has to be a cooked bear market type of scenario. Although obviously it's possible. 415 on Tesla. The majority of you right here voting for bull market. 40% say bull market, 22% say bear, 39% say flat. Tesla got an upgrade. I think that's why it's potentially going up today. But I think that's like the extent of the reason. Again, Elon said some good stuff with Ron Barron over the weekend when he had his keynote. He said that Optimus could solve poverty, which would be kind of crazy if that happens. And then they talked about CyberCab, the next gen chip. I mean, they talked about a lot of stuff, but I don't know if that's enough of a reason for why the stock is up. Tesla right there, 415 on the day. Nebius is at 87. That's still up 4%. BM&R down 6% on the day. You were seeing an obviously compression of BM&R relative to ETH because ETH is not down 6% on the day. ETH is down 3%. But ETH trying to hold on to 3,000. Bitcoin well below 94, folks. It was at 95 20 minutes ago. So that went back down to the 93s. And then Nvidia at 186. Amit, any thoughts about Steve's tweet about the AI bubble? I think Steve is 1,000% correct. I'll link his tweet for those that haven't read it. You know, when you look at the numbers, it's really hard to say we are in an AI bubble. It just really is. And this is not based on narrative. It's not based on emotion. Like, you know, me and Steve have gone through the numbers a million times on the stream. But if you read this tweet in the chat, the EPS multiples just don't look like they're in a bubble. I mean, again, Cisco peaked at 185 times earnings. Nvidia's at 50 right now. And Nvidia's growing at a much higher volume than Cisco. So it really begs the question why people think so. Here's a clip I played last night that I also thought this was, you know, really important. But the idea of what's different between now and the dot-com bubble, particularly around the technology build out that's taking place.
Of being a tech investor during the year 2000 bubble, which was really a telecom bubble. And I think it's really helpful to compare and contrast today to the year 2000. You know, first, I think Cisco peaked at 150 or 180 times trailing earnings. Nvidia's at more like 40 times. So valuations are very different. Most important, however, is that the year 2000 internet bubble or telecom bubble was defined by something called dark fiber. And if you're a veteran of the year 2000, you'll know what that was. But dark fiber was literally fiber that was laid down in the ground and not lit up. Fiber is useless unless you have the optics and switches and routers that you need on either side. So I vividly remember, companies like Level 3 or Global Crossing or WorldCom would come in and they say, we laid 200,000 miles of dark fiber this quarter. This is so amazing. The internet's going to be so big. We can't wait to light these up. At the peak of the bubble, 97% of the fiber that had been laid in America was dark. Contrast that with today. There are no dark GPUs. All you have to do is read any technical paper, and one of the biggest problems in a trading run is that GPUs are melting. And there's a very simple way to kind of cut to the heart of all of this. It is the return on invested capital of the biggest spenders on GPUs, who are all public. And those companies, since they ramped up CapEx, have seen, call it a 10-point increase in their ROICs. So thus far, the ROI on all the spending has been really positive.
I mean, I think that's a reasonable point, right? Dark fiber versus GPUs. There are no dark GPUs. In fact, there's not enough GPUs to get out there into the world because they continue to be used. S&P, by the way, losing 670. Wow. That was very quick. It was holding 671, now 669. I'll see if there's any headline. But that one going red right there. Until we see evidence that GPUs have more supply than demand, I think that continues to prop up the broader argument that the CapEx spend will continue. What happened right there? Did Trump tweet? That was basically low of the day, right? Yeah, well, not low of the day, very close to low of the day. Let's see. By the way, okay, Trump did tweet. I don't know if that's... Okay, he said, I will be strongly endorsing against any state senator or House member from the great state of Indiana that votes against the Republican Party by not allowing for redistricting for congressional seats in the United States House of Representatives. Democrats are trying to steal our seats everywhere. This all began with the rigged census. We must keep the majority at all costs. Republicans must fight back. I don't know if that's enough to move the market. But Trump did tweet last night that he is encouraging the House to now vote for the Epstein files to be released. He is encouraging the House to vote for the Epstein files. So it's a full 180 from his statements over the past couple of months on this Epstein thing. And he said, House Republicans should vote to release the Epstein files because we have nothing to hide and it's time to move on from this Democratic host perpetuated by the radical left lunatics in order to deflect from the great success of the Republican Party. I don't know why he pivoted like that. It obviously begs the question, like, if you're going to release it now, why didn't you just release it 5 months ago? But that was the statement last night. So I think the vote is tomorrow on this Epstein thing in the House. And then we're going to see when it comes out. 669 on the S&P. We are very close to lows of day at 668. And we're going to see what plays out there. There you go, 668.97 on the S&P. Well, that's another headline that's there from Cactus, and I heard this last night as well. Technically, Trump opened up an investigation, right, on Bill Clinton and Reid Hoffman and all these guys. We covered that last Friday. So legally, when you have an investigation open, the DOJ does not necessarily have to release every single file, even if the House would subpoena them to release it. So, one could argue that maybe some of this stuff is going to be held back and it's not fully going to be released given the ongoing investigation. But, we'll get more details on that throughout the week when the vote actually comes through. 669.45 on the S&P, losing 670, just hit 668 for a second. As that one got hit. Robinhood down 5% on the day. Amazon down 2%. And Palantir still down 2%. Here's the professor and some of his thoughts on what he thinks is going on with the Fed.
If you take out the AI, the Mag 7, you're really closer to 20 times earnings. And I've written that 20 times earnings in the market today, given interest rates, liquidity, et cetera, is the right ratio. So the question is AI priced too high or not? Now, obviously it's almost a third of the S&P. So I'm not saying if it goes down, you're going to go down on an index. But you have to admit, AI is a revolution unlike anything we've seen in our lifetime. It could bring benefits that we don't even know about at this point. I think the biggest risk on AI investing may not be whether it works or not. I think it's going to be worked, but can it be done much more cheaply? Do we need $1 trillion of data centers? Remember when we went back to the .com boom and bust, what really caused the bust was they figured out how to put 1,000 times more data through the fiber optic cables that they were laying. All of a sudden, the multiplexing and all those companies that said, we're just going to, wire the universe, said, you know what, we don't need that much. Is there a possible, and I'm just putting this out here, a way to get AI without spending the hundreds of billions of dollars on these centers? But AI, no matter what happens, is really going to totally transform our economy.
Professor, how many times have we called Professor Siegel a perma-bull, Andrew? You have lived your entire life with that moniker. And I think you could speak to this, Professor. If the Dow was at 780, that's when I remember, I think I was in Merrill Lynch trading class. And so maybe I don't know, my muscle memory is if it was at 780 and it's now at 47,000, being a perma bull has been the right thing to do. And I know perma bears. There's guys that were interviewed by Barron's every week. Yeah. They were perma bear. Can you speak to that? Perma bears are always in fashion. They're always in fashion. Perma bulls, if you're wrong once, you're going to get written up all over. Why does it work that way, where it's so fashionable to be a perma bear? And I'm not going to mention any names, but they know who they are.
Yeah,
but they can always get written up.
Being
there's one.
Joe, my publisher, when I published Stocks for the Long Run, said, Jeremy, do you know that bearish books, cataclysmic books, doom and gloom books outsell optimistic books by 5 to 1?
Here I am, writing about the crash.
Writing about the past. You're not. That wasn't a predictive.
That's true.
Sorkin, go ahead. Sorry.
I mean, it's just people think if you're an optimist, you're wearing Panglossian glasses, rose color. You don't get it. People who are optimistic don't get how bad things really are. I heard you, we're talking.
Hey, he's right about that, dude. I see it on Twitter as well. I mean, like if you're more bearish than not, you tend to get more attention, especially when things are already down. So, I mean, there's a fair point to that argument. The question is going to become, is there a logic behind being super bearish? And I think that's what the market is trying to figure out right now as well. S&P officially new lows of the day, 668.50. Starting off Monday, going red. Dude, you thought we had a little bit of relief on Friday, and we did. But goodness, continues to be ugly right here as we start off Monday morning. Google still holding on. That's your pocket of safety. Duolingo wrecked, down 5%. AMD down 2%. Micron, a little bit of safety right here. D-Wave down 3%. Apple down 2%. Apple tried to hold on to 270. Bitcoin, wow, potentially below 93, folks. You got a potential 93,000 or below $93,000 move. VIX is up 9% of the day. That is correct. I mean, again, a lot of these names are getting hit as the market gets hit. Like SoFi below 27 to me, looking at their earnings, given it was 32 last Wednesday. It's not like SoFi got into some bubble. I mean, like, did not tell me 32.50 on SoFi is a bubble. Like, I could understand if it got into the 40s or 45s, but Robinhood at 150, I think, was obviously extended, and I think most of us agreed on that. SoFi didn't get extended. 3250 is not an extension on SoFi that's that dramatic. SoFi is just getting, blocked into a bunch of the banks that people are afraid of potentially having bad credit. And that's why it's getting hit. BM&R, obviously, you got people running for the hills today on this one. 171, down 7.8%. ETH is struggling to hold 3K. That's correct. That's going to make it harder to dilute, to buy more as well. Brian Armstrong, Coinbase CEO, says crypto market structure bill is nearly done with only 10% left before it clears committee by Thanksgiving. That is bullish for the FDIC and the introduction of those crypto bulls, or the crypto bills. Mitt, did you sell your hood spreads? Yes, I sold my hood spreads back in May. I probably sold them too early, to be honest, but I sold them back in May. So for hood now, I just have stock. I don't have any options. The only options I have going into next year are grab with some debit spreads, which potentially I might sell half of those by the end of the year and just put it into the stock, but no other actual options going into next year, at least leaps, I guess. Enphase 52-week low. Solar's getting hit as well. Wow, Enphase low 28. Goodness. Let's listen to Stacy from Bernstein. He'll give us an update on what to expect for Nvidia this week, but that is the thing that I think the market really is now paying attention to on Wednesday.
Effectively, I mean, he put a slide up right behind him that effectively said numbers next year are way too low. I mean, he talked about $500 billion in orders for Blackwell and Rubin cumulative across 25 and 26. And if you kind of back into what that implied for next year relative to where the numbers are, I mean, he was basically telling everybody numbers need to go up. They're too low. So I even think those announcements were fine. Clearly, there's been some nervousness in the space and nothing's really been able to hold on over the last month or two. But my guess is when Jensen talks on Wednesday, like hopefully that can help. Maybe that helps put a bottom under things. Depending on how he sounds relative to what he was saying.
How far can he project, Stacy, into the future? Because isn't that where the real questions are about when all this growth starts to flatten out?
Yeah, and certainly, but I mean, he's got some visibility at least on his order path, and so we'll see if those orders, get fulfilled or not. But I mean, even the numbers he put up, that would basically imply we don't get any more orders between now and the end of next year. So if anything else, in this environment, there's probably an upward bias even to what he said. So, yeah, but I get the general nervousness. This has been the story since it started, right? I mean, just the numbers have gotten so big, so quickly. Everybody just wonders how sustainable this can possibly be. And I mean, I'll say the same thing that I've said many times. Like at some point, I'm sure there will be some kind of an air pocket or a digestion or something, but it's not now, and it hasn't been now. It's not this year. It doesn't seem like it's next year. And I mean, like even all the stuff with OpenAI doesn't even start to ramp until the end of 26. So if that keeps going, it's probably not 2027 either, right? I mean, clearly the stocks may react like earlier, but just in terms of the spending trajectory, right now it still looks full steam ahead, I think.
Yeah, it's obviously the key question is how equities price in that second derivative or price ahead. You must have a view, Stacy, on this debate regarding depreciation schedules in accounting. What should viewers think? How should we think about that?
Yeah, you bet. So there's been a lot of worry that that hyperscalers maybe are using too long of a depreciation lifetime for these GPUs. They're mostly saying 6 years, and a lot of people are saying 3. And these things do not turn into like dust after 3 years. They're very usable. And if you actually look at where they're pricing, they're pricing older generation stuff at actually very attractive levels. If you just, for example, we're just to look at the cash cost of running even these older GPUs, they're much, much lower than the rental prices that they're getting for those GPUs. So it's still very attractive to run them. I personally still think it's a function of demand. Like right now, there is so much demand that it is very, very economic to keep running these older GPUs as long as you can. And we're seeing, 6 years, maybe even more. I think the way that breaks is if the demand is no longer makes it viable, then you would want to push more to the new stuff that's more efficient. But frankly, if demand rolls over to that extent, then, GPU depreciation lifetime is going to be the least of our worries.
What about competition? Doesn't that keep coming up too? I mean, now that we're starting to see big deals by Broadcom, by AMD, Qualcomm is in the space now with data centers. Is that a threat to Nvidia's dominance?
I mean, this is semiconductors, and it's a huge market. There's always competition. I would say at least Nvidia is doing a really good job of investing and moving the goalpost, pushing the envelope, right? Everybody else is still trying to play catch up. I still feel like worrying about competition is the wrong question. Like right now, I think the question is still, is the market in front of us still large, or is it not? If it's still large, then there's room for multiple winners here. Like lots of Nvidia and Broadcom and all these others can still do very well. And if the opportunity in front of us is not good, then everybody is screwed, right? So I mean that is the question. Hopefully we're not in a mature, saturated market yet. Right. I mean, so that's the question. Do you believe the opportunity is still big, or is it not? I still think it's big.
You got Stacy right there, not concerned too much about this depreciation argument, which I think is fair. I mean, there's other things that matter a lot more in this. Bitcoin right here did touch 92 again, 93,130, bouncing back above that, but still red on the day. Hoodie, basically low, 115.80. Again, I think the hood drawdown is nothing fundamental. It's just crypto. It's the markets thinking that crypto volumes are going to go down, which I thought they would be down in October because October Bitcoin was flat, but crypto volumes were up in October. So I don't know if the market necessarily has it right that just because crypto is going down, the volumes will be down. But if it is down in Q4, then that's why you see hood taking a beating right there. Amazon 230, that's down 1.72, and then SoFi down 2.73. I think with a lot of these names, for people asking like, are these dip buys? It really comes down to your timeline as well and your position size, right? Like on hood, if you've been buying this thing since 30, 40, 50, and you think 2026 might not be super bullish, 115 is probably not the best dip buy because you're buying at 115 because you think it's going to go higher. I mean, if 2026 isn't as bullish as 2025, hood might not have the earnings growth that gets you a move back up to 150. Granted, if you don't have a position on hood at all, and you've been waiting to buy this thing and you don't want to wait until it goes to 100, that's basically me with Meta, right? The reason I bought at 620 was like, well, I don't want to wait for it to go below into the 550s, which who knows, that might end up happening. But at some point you got to nibble, right? And you're likely going to be wrong when you nibble, but like it's inevitable. It's very, very hard to time the bottom. So I think it depends on your position size, your conviction, and then where you think 2026 is going to go on buying these names. Like if you think crypto's done for the next couple of years, then BM&R is not a buy. Neither is MicroStrategy. Neither probably is Hood or Coinbase because although I think Hood is way more diversified, that's obviously going to affect them next year. Is it risky to buy Leaps now? I personally don't think Leaps make a lot of sense at the moment. I mean, Leaps makes sense if you really think by like 2028 or end of 2027, whatever time frame you're going for, you think a stock is going to be significantly higher than what it is today. I just think the broader market is expensive, right? And I know things have taken a haircut, but still, a lot of these names are up a lot year to date. Now, like a SoFi that hasn't broke out like crazy, does a SoFi, $35 leap in Jan 2028 sound crazy? No, that's kind of reasonable in my opinion. But then again, you just don't know how 2026 is going to play out. And so it could seem cheap based on your conviction. It could seem expensive if you think SoFi takes a bit of a breather. But a lot of it depends on kind of where you think it's playing out. Would you sell puts on SoFi? I mean, these are levels that I think are relatively, I think 24 to 25. SoFi hasn't seen below 25 in about 2 months. So I think that 24 range is, at least you're getting some bang for your buck. I don't hate puts there. But I'd rather be a put seller than an option buyer in this type of volatility. And the volatility could lead you to getting assigned on those puts, but at least you're getting a better deal than buying the option itself. What else do we have? Tesla still holding its green. That one's holding on. By the way, Jensen answered some questions from analysts. Tesla still 416, just incredible for Tesla. At their UBS Financial Investor Day, this was last week, when he was specifically asked about Nvidia versus custom ASICs.
With you, and maybe how some of your conversations with these same customers would sort of form your view in terms of how competitive custom ASIC will be to you. Thanks.
First of all, just because something gets built doesn't mean it's great. Number two, If it's not great, all of those companies are run by great CEOs who are really good at math. And because these are AI factories, and it affects your revenues, not just your costs. It affects your revenues, not just your cost. It's a different calculus. Every company only has so much power. You just have to ask them. Every single company only has so much power. And within that power, you have to maximize your revenues, not just your cost. So this is a new game. This is not a data center game. This is an AI factory game. So when the time comes, that simple calculus, as I was using yesterday, that simple math that I was showing yesterday, still has to be done. Which is the reason why so many projects are started and so many are not taken into production. Because there's always another alternative. We are the other alternative, and that alternative is excellent. Not normal excellent, as you know. Everybody's still trying to catch up to Hopper. I haven't seen a competitor to Hopper yet. And here we're talking about 40x more.
So Jensen, defending that, like, the custom ASIC solutions that people say are so amazing aren't horrible, but they're not even as good, in his opinion, as the most, generalized version of NVIDIA chips, especially the ones that are, not catching up to Hopper. So you got Jensen that's pretty damn optimistic, and that's why I think Stacy says earnings are going to be really strong, as the guidance for NVIDIA has also been really good as per GTC last week. But I think the macro economy is going to matter a lot more than just the earnings. NVIDIA right there, 186.60 on the day. How's Applied Digital doing? They had a bond sale as well that didn't go that well. That's up a little bit on the day. Their bond sale didn't fail, but there weren't as many buyers for their bonds. Wow, they were issued at 97 cents on the dollar with a 9.25% coupon. I mean, Wolf and Cypher did it at 7.7%. So they had to give an extra 2%. Applied Digital is going to be paying $217 million on the bonds every year alone. Some of these names, dude, they're not really getting great financing terms. They're not like Meta or Microsoft that are actually, or Amazon or Google, that are able to get decent pricing. And that's another reason why the data center plays have continued to get hit. Would you sell calls into NVIDIA going to earnings? I mean, look, for NVIDIA to get a move back up to like 205, 210, I think you would have to have such a good quarter and such a good macro. So yeah, I don't think selling calls are crazy. I mean, like the $200 call going into earnings is not wild to sell. The question is how, good of a beat and raise do you think NVIDIA is going to put up? And if we get macro data that leads to a rate cut that then kind of gets everything going in the right direction, does NVIDIA kind of keep compounding from there? So granted, what do we put in the chat, what do you realistically think NVIDIA ends the year at from a price perspective? Like realistically, I'd be happy if we end the year at 195. And, do I think 210 is possible? Yes. Do I think 180 is possible? Yes. But I think like 195 would be nice. And I don't think it's super, super crazy. I don't think it's too low, too high. But I think a lot of it depends on is the market ready to cooperate with an NVIDIA at 5 trillion by end of year? Wow, people are way more bullish than me. Okay, Doug says 235. I don't know if 235 is happening. Remember, NVIDIA has 25 billion shares outstanding. Every dollar is an extra 25 billion in market cap. I mean, dude, I'd be happy if we end the year back at that $200 range. Look, S&P 7,000, yes, NVIDIA is probably closer to that range. I just think once we get the labor market report, it'll give us a lot more clarity on where it goes. But I don't think 195 is bearish. Dude, 195 is up freaking 50% for the year. I think that's actually pretty damn bullish. Now, 175, 180, it's okay, you're not really, expecting NVIDIA to make a big move by end of year. But 195 is just getting back to where was that all of September, which I think most people were happy seeing NVIDIA holding the 190s in September. S&P getting a little bit of a move higher, trying to go green again. This is part of the choppiness of the past couple of weeks. BMNR bouncing off 31, now at 32.40. Nebius trying to push 90. Where's Hood? Are we trying to push 119? Hood 117.45 up from 115. Every day, dump, V-shape, dump again, V-shape, And then by the end of the day, it's either a little bit more of a dump or a little bit more of a flat to greenish V shape on the day. Tesla, winner of the day. Look at that. Tesla trying to go back to 420. It's leading most of these names. That means Google should be pushing 290 again. Google, 288. Trying to go up. We've been spoiled. We have absolutely been spoiled. 100% been spoiled. Dude, but does any, I don't know even know if we can trust this little mini V shape we're getting, because it could be followed by another little downturn. Like, it has completely ruined the trust of people thinking that, okay, that was the bottom. It's like, nope. You can get whipsawed right back down. Now, in the face of this, again, we shared this charts last night. Institutions are buying stocks, and they're buying it at some pretty aggressive rates. Hedge funds and honestly, retail investors have tended to become net sellers. So with the institutional inflows that are coming in, especially as dip buyers, it kind of goes back to that argument that Tom was making about chasing towards the end of the year. Institutional investors bought U.S. equities in 60% of the S&P 500 declines of at least negative 1% this year. It really would be hilarious if, because the Toots missed March and April, they're playing all these games to try to get stocks to get to levels that are reasonable enough for them to buy going into end of year. Like, that is the most optimistic kind of like, oh, they're just messing with everybody and they're scaring people out of their stocks. The more pessimistic scenario is there's a real issue in the labor market, and that's why people are scared. And I think over the coming days at this point, someone said the jobs data is out Thursday. I think you're right about that. I'm going to try to get confirmation. But if the jobs data is out on Thursday, then we should know this week what the labor market is looking like. That should give us a little bit more clarity on how this is playing out. Let's get some updates on the Fed and liquidity. And this has to do with some of the repo markets and the stress on those markets as well.
Volatility in the past several weeks, and it has gained the attention of market participants and the Federal Reserve. A New York Fed official confirming to CNBC over the weekend that President John Williams quietly convened a meeting with representatives of most of the 25 primary dealers, urging them to continue using the Fed's new standing repo facility, which was put in place in the wake of the pandemic, to serve as a backstop for these kind of volatility increases and liquidity crunches. The repo rate, used to finance trillions in treasuries, you never hear about it. It's the plumbing of the system. Doesn't usually move unless the Fed moves, but it's been far more volatile lately, a potential sign of a lack of liquidity. Volatility has come down since the surge at the end of October, but it's remained elevated, and there could be more to come. Among the reasons cited for this stress, the decline in the Fed's balance sheet, maybe removing too much of that liquidity, the rebuilding of the Treasury's general account, strong bill issuance by the Treasury, and banks being reluctant for whatever reason to lend right now into the repo market. Fed hoping that by urging dealers to use this new facility, it can avoid an intervention, but it's untested. And Bank of America warning in a report that there will be new challenges coming from the settlement of massive amounts of treasuries in the next several weeks and the end of the month and the end of the year, when, you know, guys, we have these regular scrambles for cash and liquidity.
So should we be worried at this point or reassured because they're on top of it early?
Do I get a third choice on that one, Sarah? I would say we need to watch it. We need to watch it. It may be that all this stuff smooths right over. We want people to be aware of it. It has not affected equity funding to this point. That's a good development. It could be that the Treasury bringing down the general account. Remember, it ramped it up, and as a result of coming out of the debt ceiling debate or the debt ceiling problems they had. So that could come down. That could add some cash to the market.
This was basically the emergency meeting they had on Friday. It's not as big of a deal as some people have been making that emergency meeting, but it's more so a question of just making sure liquidity continues to stay strong. And, you know, the Fed wants the banks to continue using the repo rates that they've been issuing. But, you know, the labor market, I think, really is going to depend, or is going to define how much of these things potentially become an issue. And that's what the market's trying to figure out. S&P just went red after going green, but you do have a little bit of move right there. Tesla, 420. Don't know what's causing the move on Tessie, but something's causing it. 419.22. on Mr. Tesla. Aren't these moves of consolidation and pullbacks great for the market's health? Yes. I mean, look, that is another thing that we talked about last week, but it's great to, say again, a lot of the consolidation is pretty healthy, as much as it's annoying. And it brings new buyers in. It allows share prices to stabilize. Like, yes, Hood's not at 150 anymore, but it probably never deserved to be at 150. So consolidating around that 115 to 125 range is good, even if people are annoyed about that. And that's healthier to get the next leg up. Also, what's healthy is this rotation. We've seen tech have outflows over the past 2 weeks, and healthcare and defensives have inflows. That means that Google, Amazon, Nvidia are not the only reasons for why the stock market's up. You have other names participating. So it is annoying because a lot of people are afraid that the lack of data in the labor market are causing the weakness, which, could lead to more weakness. But if that's not as big of an issue, if it's more so just like prices need to stabilize, then it's actually pretty healthy and it's more broadening up. But obviously, I think a lot of that will be proven right or wrong as we get more data. S&P 671.22 is that screen. Palantir cracked below 170 for a second, now back to 172.65. Again, dip buyers are very strong on Palantir. People want exposure to this name, and when you have 63% earnings growth, you're going to have more and more people that are willing to buy. Palantir right there, 172 as that continues to go green. Sav, thanks for the super chat. Do you think Tesla's going up has anything to do with Elon's tweet regarding Bill Gates and short covering over the weekend? No, just because I think Tesla is a lot more complex than an Elon tweet at this point. I mean, Elon sometimes can control the price with his tweets, but a lot of the times it's a lot more stuff that goes into it. However, Elon did say, for those that missed the tweet, that basically Bill Gates is going to be screwed if he's still short Tesla. So could that lead to some excitement from people being like, oh, I want to buy Tesla? Because, like, yeah, sure. I don't know if that's enough for a 3% move on a almost $2 trillion company. Tesla right there, 420, 3.9% up on the day. But he did explicitly say that if Bill Gates is still short Tesla, he should be afraid. So obviously Elon is very excited about the trajectory of Tesla. And he bought $1 billion worth of stock at 380. So, he did put some of his money in at the lows of the year. Or at least the lows of the past couple months. We are in extreme fear. We're back to 18. Dude, we are just wobbling on this fear and greed every day. From fear to extreme fear. If anyone's trading extreme fear up and then fear down, going long extreme fear, short at fear, it's probably been working really well. Bill Gates sold his Microsoft shares to cover his short. Well, so that's a theory that's out there. First of all, we don't fully know if he's still short Tesla. So we can't conclusively say that he sold Microsoft to cover his short. That would be hilarious. But I am confused why the hell he sold 65% of his Microsoft. That's weird, bro. Well, it's not his Microsoft, but it's the Bill and Melinda Gates Foundation stake of Microsoft. Like 65%. Like, I understand taking some profits, but it's a more than 50% reduction in one of the leading companies of AI. And all he did was sell. I mean, there's no buys at all as per the 13F. So I don't know. I thought that was kind of weird, but maybe there was a reason for that. Yeah, extreme fear for like a month in crypto. That is true. Got to the lowest level it was at yesterday's. Bitcoin still holding 93. Bitcoin, Tesla 420.21. Bitcoin 93.8. All right. A little bit of rebound. Trying to get to 94. All right, folks. I think that is it for the day. It's about 11:40 right here. Didn't even realize it was 11:40. SoFi down 1%. S&P, again, is flat. We'll see on the market close how flat it continues to be, but 4 cents away from going green, 671.58. And then Hood down 3, Palantir barely down, Tesla, Palantir down 0.5%, Tesla up. Tesla's the story of the day, up 4%. Bitcoin trying to make a move back to 94. Nvidia also down 1%, not that crazy. And then Google got the Berkshire stimulus. And that's why that's up 5%. Maybe there's some news on Tesla coming out that the market might know about. Maybe there's something we got to keep an eye on, but obviously if you're holding Tesla today, you are definitely liking the price action. 288.75 on the Googs, Tesla 420, Hood 117, and then Palantir 173 on the day. Yeah, maybe the flying car, maybe that's coming out. I mean, that would be, he did say there would be an event by the end of the year. So if we do get one, that'd be kind of crazy. All right, word of the day. What do we got? I'll be back on the close. We have no earnings today, so nothing too crazy. We're just going to take a look at kind of how these markets play out as we get into the end of November. Word of the day is sabaritic. Sabaritic. Luxuriously self-indulgent, devoted to pleasure, comfort, or refined sensuality, often used to describe an extravagant lifestyle or taste. I've never heard of this word before. Sabaritic.
Sabaritic.
Okay. Whatever. Whatever. Sabaritic. He lived a sabaritic life, fine wine, tailored suits, an apartment that looked like a design magazine. All right, well, J-Pow's making sure that none of us live, how do you say this shit again? Sabaritic?
Sabaritic.
Sabaritic. J-Pow is making sure we don't live sabaritic lives. And, you know, that's that's how this market is playing out, at least right now, until we get Nvidia earnings. So that's what we got going on. The NYC meetup will be sabaritic. Yes, we will try to make it sabaritic. I said this last night, but New York City meetup is likely going to be happening in January. Don't hold me to the date, but we're looking at January 25th. That'll be a Sunday. I will have details probably in 2 weeks. And there's going to be a lot more formal. We're renting out a venue, food, security. So I'm working with a team, and we're going to try to make these meetups just a lot more of an experience. So even if we do enter a bear market, which I don't think we are, but if we do, you know, I think community is going to be important next year. And regardless, I think, you know, people really enjoyed the meetups we had last year. So we are going to keep it going. So yeah, likely January 25th. I will have details in a couple weeks. It's going to be limited to about 300 spots because I think that's the max we're going to be able to handle. But we're finishing up finalizing the venue, and then we will get these meetups in place. So I will try to let you guys know at least 2 months in advance. So if anyone actually wants to buy a plane ticket or make a trip out of it in New York, then you can. Meet up in New York City at White Castle. Well, J-Pow better make sure it's not a white freaking castle. That's all we got to say. But it should be fun. It should be fun. So I'll have a lot more details in a couple weeks, and then we'll keep going. And then obviously LA is on the list, Singapore's on the list, UK is on the list. I'm working with like a legit team now, so I think it'll be a lot easier to actually manage and plan these meetups. But yeah, New York should be the first one, and January should be the day. All right. Thank you, everybody. Appreciate it. I will see you guys on the close. We'll see where the market reaction goes. Again, relatively flat on the indices. Tesla's going green. Hood's down 3%. Palantir down about 0.5%. Crypto trying to bounce a little bit. So at the close, we're going to see how these prices play out. But that's kind of what we got for the market open. All right. That's it. Thank you, everybody. Appreciate it. I'll see you guys on the market close. Bye, everybody. Have a good one.